On behalf of SIRC, I welcome you to this transfer pricing session. Before we start, let us stand up for the invocation song, ICAI invocation song.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता
I invite the speaker to the dais, Mr. Prasanna. Please be seated, sir. A brief introduction about Mr. K. Prasanna. Mr. K. Prasanna is a chartered accountant and a commerce graduate with over 14 years of experience in corporate and international tax as well as transfer pricing. Prasanna has extensively advised clients on inbound and outbound structuring, holding jurisdictions and business model evaluation. He has also extensively has experience in handling corporate litigation. He won the FIT fellowship scheme from the Foundation of International Tax for 2018 and 2019. He is also a regular speaker at the study circle of ICAI, IFA, BCAS and CTS. Contributed articles in contemporary issues to various professional journals. Joint feature contributor in the journal published by the Bombay Chartered Accountant Society. He has contributed to the book on demystifying section 194R published by Tax Sutra and CTC. A warm welcome to you, sir. Now I invite CA Ramachandran to present a memento to our speaker, Mr. Prasanna. Yes, sir, you can start.
Thank you all. Very good morning. I thank the SIRC for giving me this opportunity. I also see some of my seniors present here with whom I've learned this subject. I'm still learning from them. So once again, a very good morning to all. See, we just fresh out of the transfer pricing season, which got over in 30th of November, so rather 31st of October. And then we are getting into a litigation space where the timeline for completing the transfer pricing assessment is getting over by 31st Jan 2026. So when the institute approached, let's do a transfer pricing session. So we bifurcated this session into two aspects. One, to deal with certain fundamental aspects which lays down the ground rule as to how do we approach transfer pricing. And the second part of the session, which will be later conducted by Mr. SRINATH and Harish, where how do we manage assessments, because we would be receiving lot of notices where some of the controversies could emerge in the form of characterization of a particular entity, economic adjustments related aspects, some nuanced transactions with regard to intangibles, royalty and management. So these are all routine. Now it has become a routine litigation standpoint. So what are the learnings that we will have from the recent audit cycle, and how do we manage the current audit cycle is what we thought of we will lay out. So before we get into some of the rules and existing provisions of the Income Tax Act, if one were to look at what is the essential purpose of transfer pricing, if you look at one, between two countries, sorry for the interruption. So if one were to look at the objectives of transfer pricing, see, the transactions are happening between two countries. So therefore, each country would like to protect its own tax base, because whenever a particular company operates in a jurisdiction, the economic resources of the company, so of the country, is getting utilized. So to the extent of the utilization of economic resources, one has to pay their due share of taxes. So therefore, there is always a possibility. See, if you look at the recent trends in UAE, the corporate tax announced was 9%. Earlier to that, there were no corporate taxes. So there were a lot of discussions around the MNCs to shift their base or shift their operations to some extent to UAE, so that they have some bit of arbitrage when it comes to payment of taxes. In India, it was earlier 30%. Now, with the introduction of 115 BAA or BAB, the corporate taxes were reduced to 22% or 15% without the surcharge. So therefore, there is always an tax arbitrage that is available between countries, which gives an opportunity for the MNCs to set up their operation in such a manner that from a group level, even if you look at a specific entity, you may have a higher payment of taxes, but when it merges everything at the group level, there is always a arbitrage at the group level. So therefore, one important aspect is to address the tax base of the company. Second, there should not be any discrimination between MNCs or the local entities. Say for example, you look at a particular proviso in section 90, where it says payment charging of higher rate of taxes for a foreign company should not be looked at in a discriminative manner. See, there were always a set of arguments in the 1990s or early 2000s with regard to the corporate tax rates, where the foreign companies were charged at the higher rate as compared to the domestic companies because of the way in which the dividend distribution tax regime were working. Because when it comes to Indian companies, you had payment of dividend distribution taxes by the Indian entities before 2020. But when it comes to foreign company which are operating in the form of a branch or any of the permanent establishment, you don't pay additional taxes in the form of a dividend distribution. So to this extent, there were always taxed at the higher rate, and the Act also made a specific provisions because of some jurisprudence to say that merely because I am charging higher tax rates for foreign company cannot be regarded as a discriminative in nature. Apart from that, if the foreign company were to operate it in the form of a subsidiary as compared to a homegrown entity, there are no differences. A foreign subsidiary in India as well as the Indian entity which is homegrown is taxed at the same manner. If you look at 115 BAA or 115 BAB, whatever is the deductions or exemptions that are available to a Indianized entity is equally applied to a foreign subsidiary. So merely because there is a shareholding, there is no discrimination that has been undertaken. Equitable share of revenues, which we have already seen between the source and resident states, because treaty provides for allocation. And then is checking avoidance of taxes. See, if you look at this is the 25th year of the transfer pricing provisions being introduced. Before a specific chapter on transfer pricing, we have always had domestic transfer pricing in a different form. Say for example, 80IA section or 10AA section, 10A or 10AB, whenever there is a transaction that happens between eligible units and non-eligible units, there is always a specific provisions, say for example, explanation 8 to 10 or of 80IA always talks about how do you conduct between the eligible unit and ineligible units, because there is always a possibility more revenue is being accumulated in an eligible unit so that you gain deductions under 80IA or 10A or 10AB as the case may be, and get a significant tax advantage. So therefore, to curb these sort of practices, you had a specific provision in 80IA which got extended to other exemptions provision. So we always had some form of a domestic transfer pricing inbuilt within the system. And you had a look at section 48(2). Whenever there is a payment that are made to a specified persons, and if the assessing officer is of the opinion that the payment you have made is in excess of the fair market value, then they can always deny your deductions. So we had these sort of a domestic tax provision to undertake it, and then they brought section 92BA in a codified form in 2014. Just to look at an example, if you look at a situation where this I have taken UAE as an example. Say for example, in UAE the corporate tax rate is 9%, and you make a transaction, and you have another country where the corporate tax rate is 5%. So if the UAE were to make a significant loss, what is the tax portion that will come up to? So say for example, in company B, which is located in 5% tax jurisdiction, has significant profits compared to UAE, which has a 9%, where there are no profits. So at the group level, you end up paying only 750. Whereas you look at a situation, if I were to sell goods at an appropriate market price, then you would have ended up paying a tax of 950 because there is some profit in UAE. Extrapolate this situation to India front. Now if India were to make a significant profits as compared to UAE, now let's look at a situation. $1 lakh is the profit that are made in India, which will suffer a tax of 22%. So you'll end up paying 22,000. Instead of let's say India making this profits, you want to shift this profits to UAE, where you will pay only 9% of taxes. So therefore, there is a significant arbitrage that can happen because of the pricing regulations between two related parties. So to curb these practices only, transfer pricing provisions were introduced. Now if you look at the key regulations that we have, unlike other taxing provisions or taxing chapters, you have several provisions that undergoes. But when it comes to transfer pricing, if you look at the number of provisions are very limited, but the kind of issues that you will have from transfer pricing is enormous. Even if you look at the recent trends of assessment additions that is happening, significant amount of litigation comes from transfer pricing as compared to domestic law provisions. While the chapter is so small, but the effect of this chapter is so high. Mainly because of the fact is, from a global perspective, almost 70 to 75% of the transactions happens between MNCs, not between third parties. So only you have 75% of transaction between MNCs as against 25% of transactions between unrelated parties. So for the 75% of this transaction, you will have this provision applying. If I were to bifurcate it, some of the key provisions, if you look at 92 is pretty simple, which lays the foundation as to the computational part. Simply says income arising from an international transaction has to be computed having regards to arm's length price. Now you have a key definitions of AE under section 92A. There is some bit of controversy with regard to how do we read this 92A. We will look at it in a while. And you have international transactions definition, and then specified domestic transactions definition. Then computation of ALP has been prescribed in 92C. Reference to transfer pricing officer is been the aspect of assessment from a TP perspective, 92CA, and then you have safe harbor rules, advanced pricing, APA, all that. Secondary adjustment is one important aspect, and transfer pricing documentation. So we will not look at all these provisions as part of this session, whereas we will look at some of the key provisions which lays the foundational aspect, so that other parts of the provisions will be dealt as part of the second session. Now, if you look at to whom transfer pricing is applicable, 92 simply says any international transaction should be computed as per arm's length price. Now, we have to get to know what is an international transaction. International transaction says one particular definition. How do we link this section? 92B defines international transaction, and 92A talks about associated enterprise. So therefore, two important elements we have to look at. One is associate enterprise and then international transaction. Only if these two parameters are satisfied, you will get on to the application of transfer pricing. Now there are certain incidental definitions also there in 92F. So if one were to look at this 92 to 92F, there should be two or more associated enterprises which should have an international transaction for you to trigger an ALP determination. Now you also have a specified domestic transaction which are transacted between domestic parties. For that also you will have transfer pricing implications, and then the consequence is only the computation of arm's length price. Now associated enterprise, if you look at, there are two limbs to section 92A. 92A subsection 1 and 92A subsection 2. 92A subsection 1 deals with a situation where talks about three critical aspects: control, capital, management. These three aspects, the two entities should be related within these three, either of these three parameters, either by virtue of a capital or by virtue of a control or by virtue of a management. If I am able to control a particular entity, then I am become associated enterprise. This control can be exercised directly or indirectly. So for example, A holds B and B holds C. For a moment, C is in India, A and B are outside India. All these are 100% entities. So by virtue of capital, A indirectly controls C, B directly controls C. By virtue of this, A and C are associate enterprise, B and C are associated enterprise. Now let's look at a situation where there are more than three entities. A holds D, A holds B, D holds E, B holds C. If one were to look at whether D and C are associate enterprise, D indirectly controls C. What about D and B? They both are associate enterprise because they are commonly controlled by A. Because A holds in D, A also holds in B. Likewise, multiple permutations, if you look at it, either directly or indirectly, if someone exercises control or capital or management, you will be regarded as a associate enterprises. This is subsection 1. Subsection 2 creates a fiction, says for the purpose of subsection 1. Now the controversy arose from this aspect. There are some 13 parameters that are given in subsection 2 with regard to what do you call it as deemed associated enterprise. So it expands the scope of subsection 1. Now subsection 1 simply says management, capital or control. How do I look at these aspects? Was expanded by virtue of subsection 2. Now the controversy is whether 92A subsection 1 and 92A subsection 2 should be read mutually exclusively or it should be read together. We have some jurisprudence to say that this has to be read independently, but couple of high courts including the Bangalore High Court in Page Industries and Gujarat High Court in Virgems said, you look at the way the section has been worded. It says for the purpose of subsection 1. So therefore, subsection 2 cannot be read independently. It has to be read holistically along with 92A subsection 1. Even the CBDT, when they've introduced the transfer pricing provisions, they came up with a circular clarifying the intent of this. There also they have said it is for the purpose of subsection 1. So therefore, these two provisions has to be read together. So therefore, one cannot say I will read this particular provision in isolation. There is some bit of controversy is there in Income Tax Act 2025 when they have introduced this particular section. We will deal with it after we see what are these conditions. Now, if you look at, we can bifurcate this into 4 different buckets. The 12 conditions, apart from the 13, they have said we will notify as and when it is required. So therefore, if you look at, essentially there are 12 subconditions which creates a deeming fiction with regard to associate enterprise, which could be bifurcated into holding, management, activity and control. Now from a holding point of view, if you look at the direct or indirect holding by enterprise should be at least 26%, or each of this enterprise should be held by a same person, either directly or indirectly. Again, we have to read along with this. Granting of a loan in excess of 51% of total value of assets would trigger a holding control. Guarantee greater than 10% of your overall debt, or greater 10% interest in case of firm AOP or BOI. To correlate, if you look at here in this example, E is being controlled by A indirectly. E is being controlled, C is being controlled by A indirectly. So therefore, if you look at the relationship between C and E, A is controlling indirectly. So there is a common control in excess of 26% in an indirect manner. So likewise, we have to look at these sort of provisions. You don't have to look at only up to the level of B or E. You can go whichever level you want. So even if a particular group has a chain holding of 4 to 5 levels, as long as the common thread is one single party which is in excess of 26%, there is always a possibility that intermediary holding entities could also be regarded as a related parties. So to this extent, if you look at the related party definitions, varies across laws. You have accounting standards or Ind AS which talks about significant influences and other aspects. Company law has a slight variation of related parties. Your SEBI law has a variation of related parties definition. So one may have to look at the maze of these definitions and look at this particular provision in a different manner. So a particular person may be related party from an accounting standard point of view, may not be a related party from a transfer pricing perspective. One example could be significant influence. To what extent that influence is there from a 92A point of view, one has to be seen. Then second one, if you look at management control, appointment of 50% of the directors or one or more executive directors of an enterprise. So A appoints directors in company B. This is a direct associate enterprise. What happens in a situation where B and C are there, but both the company's directors are appointed by A? So here also then B and C will be regarded as an associated enterprises because the directors of these two companies are appointed by a common person. Now third aspect is activity. One entity dependent wholly on the intangibles for manufacturing or processing of goods. Direct or indirect supply greater than 90% of the material under the influences of price and other conditions. This is getting tricky when it comes to job work contracts, where I solely rely upon the goods supplied by the parent entity. In that case, will this condition triggers? If it's a parent, pretty much triggers, because by virtue of holding itself, they will fall under the aspect of associate enterprise. But what about a situation where there are no shareholding relations? Let's say, for example, you have Foxconn companies where you see lot of manufacturers for job work doing the chargers and other electronic chips. In those cases, whether Foxconn and the Indian entity would be regarded as an associate enterprise. While if you look at this particular condition in isolation, that merely because Foxconn supplies 90% of the raw materials for manufacturing in India, one may say, yeah, it is an associate enterprise. But what about other aspects? Do they have any management control? Do they have any capital control? Or are they able to influence me in the way in which I have to do the business? So a classic ruling on this aspect is rendered by the Bangalore Tribunal, which was affirmed by the Karnataka High Court in Page Industries, where the Indian entity was a contract manufacturer for Nike shoes, where they have said merely by supplying 90% of the raw materials to the contract manufacturer does not become an associate enterprise. You have to have some sort of element of a capital or management or a control of business should be there for you to trigger. Because we are reading 92A in subsection 2 in isolation, it has to be read along with 92A1. 92A1 says management, control or capital. Merely because someone is doing a job work doesn't mean I am exercising control on them. What constitutes control? If you look at, there is no specific definition there under the income tax law. A control could be in the form of a capital, a control could be in the form of a management. What about other aspects of control? Am I able to influence him in any aspect of his commercial aspects, which is provided under the institute guidance note with regard to the definition of control? To what extent the foreign entity able to influence in all the commercial and business decisions of the Indian entity? That only will determine your control. If you look at the fourth column, there are two aspects which talks about a control by an individual or his relatives, or control by an HUF or the members of HUF or their relatives. It could be a situation where you have a partnership firm where you may not have, say for example, the voting power, all that. In how do you determine he has 26% of capital or holding? Partnership firm works in a different manner, or a sole proprietorship or an HUF, where these kind of enterprises works in a different manner. Another controversy was in the context of transaction between a holding head office and its permanent establishment. So whether any of these parameters will it get satisfied when it comes to a permanent establishment? Because PE is in effect by registrations, either you set up in the form of a branch or you set up in the form of a project office or through a particular place registered with RBI. Now, head office may not have any stakes in PE, because from a head office perspective, if you look at, these are one single person. There is no separate legal entity. Only for the fiction of the tax law, these two are regarded as two different entities for the purpose of computing profits in a particular jurisdiction. But commercially, if you look at, or legally, branch or some of the permanent establishment may not have a legal existence. It is not set up through a particular law. It is registered by virtue of carrying out an operations in a particular country. So therefore, you may not be able to satisfy the first limb of aspect. Management also, if you look at, I will not be able to appoint any directors there. You may be appointing some managerial person to let's say a branch manager or something, but it cannot be equated to be a director. Then other two aspects also is some sort of a jeopardy, but the controversy is always there. And you had this special bench ruling in the case of Shibang International, where the Ahmedabad special bench said the transaction may be regarded as a international transactions, because if you look at the definition of international transaction, it says two or more non-residents. A head office is regarded as a non-resident because this is located outside in India. A PE, by virtue, it is a non-resident because it does not have a status on its own. It derives the status from the head office. So this particular condition has been satisfied. And if you look at 92F, enterprises includes permanent establishment. So therefore, based on this, they have said a transaction could be regarded as an international transactions, but they have remanded this issue of 92A1, which ambit of associate enterprise the transaction may fall. That has been sent back to the assessing officer. But one important aspect or principles which the special bench relied on is from the way in which Article 7 of a particular treaty is being worded, which talks about business profits. Article 7.1 says a business profit of an enterprise is taxable only in the state of resident unless it carries on a business in the source state through a permanent establishment. So therefore, permanent establishment is a prerequisite for a source state to tax the particular income. Now subpara 2 talks about a situation if there are profits, then such profit has to be allocated to the source state as if consider the PE as a separate legal entity. So treaty creates a fiction that if a PE were to be a separate legal entity, how do you look at it? So looked at in the same lens. If the holding company has a subsidiary in India has a separate legal entity. Now merely because it is in the form of a PE, don't disregard it. Creates a fiction that this PE should be regarded as a separate legal entity. How do you then look at the allocation of profits? Look at it in same manner. So more or less, if you look at the controversy between 92A subsection 1 and subsection 2 has been settled, but it got re-triggered when it comes to the Income Tax Act 2025. When the initial finance bill was passed, they've said both this clause were independent. So reading 92A1 is alone is sufficient. The problem that could arise from reading the subsection 1 on an isolated basis is, let's say for example, some small shareholders having 1% stake in a particular company. Let's say foreign institutional investors, where by virtue of the NDA rules, they can invest in India only for a less than 10% stake. You have several investors pooling in a particular fund and then they do an investment. And assume for a moment there are 10 different ultimate investors pooled a fund, 10% is invested in an Indian entity. Now if you look at, I have to look through this to the extent of individual members, each one have only 1%. Assume for a moment each one has 1%. Now, if I don't read 92A2 and 92A1 independently, even a 1% constitute capital. So anything less than 26% could also trigger an associate enterprise definition. So therefore, what is then the purpose of having 26% as a ceiling? So that is why we always said when Acts creates a deeming fiction, that deeming fiction should be given life when you interpret that particular provision. If I not fix the de minimis capital of 26%, even an 1%, anywhere between even holding of one share, tomorrow an employee who got an ESOP subsequently got an allotment. He may not have significant stake in that particular company, but having one particular share, only one share. And if he, let's say for example, tomorrow he moves out of India, settles somewhere in US and he becomes a resident of that particular country. He becomes a non-resident. Indian entity is a resident. By having one share, these two will be regarded as an associate enterprise. That is not the intent when this subsection 2 was introduced. But unfortunately, when they've introduced the Income Tax Bill 2025, these two conditions are kept mutually exclusive. So therefore, I may fall under this or I may fall under that. Assume for a moment someone who does not have a control but merely supplies 90% of the raw material, then these two will be regarded as a associate enterprise without having any control, management or capital. So that is the extent of the proposed bill at that point in time were made. Then subsequent to the recommendation, they modified the Income Tax Act 2025, but only to some extent. They have not addressed this aspect as it was in 1961 Act, but got diverged from this. So what they have done in Income Tax Act 2025 is only with regard to the aspect of shareholding 26% condition, they have linked this with 92A1. For rest of the clauses, it is kept separate from the subsection 1. So only with regard to capital, you may have to go look at, okay, I have to see both the conditions together. But with regard to rest of the clauses, be it in the context of loan or a guarantee or for appointment of directors, I don't have to look at the initial condition of capital, control or management. This creates a chaos. Again, for example, if a company goes for a loan from a foreign bank, and assume for a moment the loan is more than 51% of your total assets. Now, will I say the transaction between the bank and me is a related transaction, so therefore the interest that I pay to the bank should be benchmarked for a ALP, which looks little absurd, but if you look at the act, that is the way the 2025 act which got introduced. Hopefully they address this issue in the upcoming budget, but otherwise if you look at, this is the dichotomy you will have, the way in which the 2025 act is being introduced. Now coming to section 92B, which talks about the critical aspect of international transaction. It says transaction can be between two or more AEs. Either of the AE could be non-resident or both the AEs could be a non-resident. Now we wonder, why do we have to benchmark a transaction when a transaction is between two non-residents? How does it matter for India? When two non-residents are transacting, why should I benchmark this transaction? But the benchmarking would come, or the determination of ALP would come when it has an effect of having an income chargeable to tax in India. You look at section 195. There also, if you look, whenever a non-resident making payments to another non-resident, but the income of such non-resident is chargeable to tax in India, then there is an obligation on the non-resident to withhold taxes. This came after the controversy of Vodafone. You look at a situation where entity A, which is a resident of US, holding stakes in an Indian entity, 100%. There is entity B located in UK. Entity B wants to acquire the shares of an Indian entity from US entity. Now for US entity, this particular transaction is taxable because it is a capital asset of a Indian entity. It is located in India. By virtue, although the contracts are entered outside India, Section 9 creates a fiction because the asset is in India. I have a liability to tax this particular transaction. Now, if you look at US treaty also, it gives a right of taxation to India. So, therefore, even though the transactions are between two non-residents, there could always be a situation an income may be in India. Only if the income were chargeable to tax in India, then this particular provision will prevail. A transaction may relates to purchase, sale, lease, rendering of service, lending, borrowing, and the important aspect is any other transactions having a bearing on profits, income, losses, or assets of the enterprise. Mutual arrangements that are entered between the companies, say for example, cost pooling. Instead of one entity rendering services to each of the groups, multinational groups have always entered into one single umbrella agreement with the service provider. Then the service provider renders services either on its own or through its subsidiaries to all the groups of the M&E. So therefore, there are mutual agreements. And one critical aspect one has to be read, the word transaction or arrangement has been defined in 92F subclause 5, which says if you look at transaction includes arrangement, understanding, or action in concert. So therefore, a transaction, an agreement may not to be in writing. It can be oral, or it can be an understanding, or an action in concert. Enforceability through a legal proceedings is not a prerequisite. See, this issue comes up in the context of some of the internal reorganizations that one performs. Again, I'll take you to one of the jurisprudence in the context of Vodafone International, where Indian entity did a slum sale of an undertaking to another Indian entity. But this entire transaction was consummated at the behest of foreign company. So the parent entity has instructed the Indian entity, now I want to enter into a transaction to unlock some value of a particular business. So therefore, I want you to do a slum sale of this particular entity into another newly incorporated entity. Thereby, this transaction was consummated. Now, the tribunal went into the aspect of 92F subclause 5 to say that a transaction is always includes an arrangement or an understanding. Although the slum sale is happened between two domestic entities, but this undertaking has transferred at the instructions of the holding company. So therefore, it is for and on behalf of the holding company you have done this transaction. So therefore, it is an international transaction between the holding entity and then the Indian entity rather than between the two domestic entities. So this controversy could arise in the context of some of the transactions that are undertaken although between domestic parties in legal, but in form at whose behest and whose interest that this transaction has been undertaken is important. Then explanation to 92B bifurcates some of these transactions into different buckets. One, it could be a tangible property where purchase, sale, transfer, lease of movable properties or immovable properties will come. Then you have intangible properties with regard to purchase, lease, licensing, transfer of ownership of intangibles. All this aspect will come. And the aspect of capital financing where your borrowings investments, all the purchase of shares and securities, advance receivables. I think in the second session we will have a discussion over some of the litigation around the outstanding receivables. Then provision of services, which could be in the context of market research and development, all our IT, ITS and other services. And then the last limb is business restructuring. See, because some of the business restructuring may not have a bearing on profits because of a specific exemptions that are given. But nevertheless, if you look at the Form 3CB, it requires you to report these transactions. While if you look at, it does not ask you for what is the arm's length price. All it requires you is to report this transaction. So therefore, it will give the information to the transfer pricing officer whether because of this business restructuring, any income that are otherwise taxable has escaped or not. Then specific domestic transactions, if you look at, this was introduced as a result of the observations of the Supreme Court in GlaxoSmithKline, where the Supreme Court made that you can't make adjustments for every other transactions without a specific powers that are granted to you expressly under the Act. So therefore, initially if you look at, we had only the ETAA related regulations where subsection 8 to subsection 11 talks about the allocation which I have highlighted between eligible and ineligible unit, and then 48(2)(b) where any payments made to specified persons was initially introduced. So what they have done is they have codified these aspects in the form of an SGT. Earlier it was merely an allocation just to look at is there a shift in profits. I just have to prove to the assessing officer that there is no shift in profits. But now they've codified into a law to say that you have to maintain documentation. You have to substantiate the arm's length price of these transactions. Any transaction referred to in 80A look at, it will takes you to 80IA subsection 8, subsection 10, and then you had this chapter 6A or section 10AA related aspects where they would have referred subclause or subsection 8 and 10 of 80A to almost most of the tax holiday provisions. Now after this 2019, you had this new manufacturing entity where the corporate tax rate is only 15%. So therefore they have said any person transacting with the entity which is claiming tax rates under 115BAB is subject to transfer pricing. So therefore there is also an interpretational issue whether this particular documentation is anyway applicable to the new manufacturing entity. What about other persons? Because the way in which the section was worded creates a confusion whether anyone who is transacting with the new manufacturing entity is also required to maintain the documentation. The answer is no. Only those entities that are claiming low tax rates as per 115BAB is subject to transfer pricing. Why? Because your rate is 15%, there is always a possibility a company which is having high corporate tax rate in the group can always sell the goods to or provide the services through sell the goods to manufacturing entity. Instead of me directly selling the goods to a third party, I will route this goods to new manufacturing entity. What I can do is I do major portion of manufacturing, sending it to this new manufacturing unit. New manufacturing unit will do a limited manufacturing because they have to satisfy the aspect of manufacturing in that. So I will do the finishing leg of the manufacturing part and then I will start selling it. So significant portion of profits will get trapped in new manufacturing entity, whereas limited manufacturing entity will have only small profits. Because of this, there is a significant arbitrage that you could have. Almost 8% if you look at 115 BAA versus BAB. if the other entity is under 30% rate or 25% rate, the arbitrage is around 12 to 16%. So therefore, to this extent, there is always a possibility of structuring your manufacturing operations in such a manner that significant profits are getting located in the new manufacturing entity. So therefore, Act as envisaged this, there could be some reorganization that could happen between these two entities. So therefore, this is also a subject matter of transfer pricing. The threshold has been increased now to 20 crores. I have to look at this in a aggregate manner. Now, getting into the core aspect of transfer pricing, we have identified now, okay, these are associate enterprise, these are international transactions. Now, one of the critical aspect is the functional analysis. If you look at OECD para 1.26, all it talks about the comparability related aspects. I have to look at contractual terms, what are all the functions, assets and risk of that particular transaction, who performs what functions, who undertakes what risk, who employs what sort of an asset, and what is the nature of that property is being transferred or services that is being rendered between the parties, what is the economic circumstances through which the transactions are undertaken, and what are the business strategies. Why business strategies are essential is, see, say for example, you have this startup related entities where if you look at, they able to do significant marketing, they able to burn their funds in marketing and other aspects, but at the end of the day they may not have significant income as compared to a marketing cost that they are incurring in the initial stages, but you can repeat it later way. That is the strategy they are adopting. So likewise, as a group, what is the business strategy you are adopting? Say for example, if you want to getting into a new market, you may want to go with the low prices to bring in more customers. So some of these strategies, what is your approach is also essential. If let's say for example, in this marketing strategy, who designs that particular strategy? Who decides those particular strategy, whether it is the Indian entity or whether it is the group, will also be critical when it comes to who has the decision making power. The person who undertakes the decision should ideally assumes the risk, not the other way. Say for example, if I give a goods to job worker, it is the decision of mine to give the goods to a job worker. Based on that material manufactured by the job worker, I went into the market and sold the goods. If there are any defect in the goods, who is responsible? I am the seller. I will be responsible from a customer point of view. I may have a back-to-back arrangement with the job worker that tomorrow if something causes to the goods, I will hold you responsible. But from the perspective of the market, it is not the job worker's responsibility. I may minimize my risk by having a back-to-back contract or by taking an insurance. But that doesn't mean that I cannot say I will not assume the risk. It is someone else manufactured. So this is critical when it comes to the analysis of transfer pricing and comparability factors. So that is why your entire determination of ALP and then the substantiation of the ALP FAR is the core, heart of the transfer pricing. So if you look at it is a transaction between third parties, compensation usually reflects the function. Right, if we let's say if a client engages us for a particular work, It is for the functions that we do and the knowledge that we possess. If it is not commensurate with it, then we may not agree to that particular engagement. The purpose of FAR is to identify what is the core activities of a particular transaction. You don't have to get into each and every elements of the activities. Only those activities that contributes to the value chain. Say in a manufacturing entity, what and all critical elements that contributes is what we will identify. Say for example, you may have a warehousing. Warehousing is an important part, but a person who is guarding the warehouse is not important for the transaction, whereas storage of goods is a critical aspect. Now, if you look at the component side of it, if I were to bifurcate this into various buckets, functions, risk and assets. Functions, if you look at right from my raw material procurements, manufacturing, product research, design, development, production scheduling, quality control, packaging. Up to this will be a manufacturing. Possibly you may have a different entity which is doing a distribution, where people would be in the market negotiating with the customers, entering into contracts, doing a distribution related works, delivery of goods. Then there could be related to a services where sales support services, warranty related, all this would come. You may bifurcate this entire activity into various entities. Say for example, one can look at this into 4 different entities. One, say for product research, design and development could be done by one single entity. Production scheduling, raw material purchasing, manufacturing, quality control would be done by one entity. Sales and distribution could be done by another entity. Fourth aspect is after sales support. So all can be in different entities, or all this could be in one single entity. Now, as a consequence of these functions, you tend to employ significant assets, because if I have to manufacture, obviously there is a requirement of me having a plant and machinery and other factories. For storage of goods, I may either go for warehousing on my own, or I may go for third party warehousings. Use of technology when it comes to manufacturing of these products, I may have my own technology, or I may borrow technology from another party, which may be a group entity or it may be a third party. So some of these aspects would come in the form of your assets. Then as a result of all this, you will have a risk, because any business activity you do always comes up with a risk. Say for example, you go to a different country, you may expose to a political or an economic risk. How is the take an example of having a business operations in Bangladesh, because of huge turmoil that would have happened that had happened in the last couple of years. Your business operations may tend to disrupt. So therefore, how the political or economic situation in a particular country will also cause a risk for you. Product risk also. Classic example is Nokia, where they were in the peak when it comes to when they've introduced Nokia 1100 and 11008. But after the Android phones and Apple phones came in, they never upgraded themselves into that particular technology. So therefore, there is always a life of a particular product. The moment you go beyond that life, the market saturates. Market is also one of the risk. If you don't have any buyers, you tend to develop a particular product, but by the time it reaches the market, it becomes obsolete. The moment it becomes obsolete, there will not be any significant buyers for you to purchase it. So therefore, market risk is also a important factor. Credit risk, how much time that you take to collect the debts. The more the number of days you take to collect it will hit your working capital cycle. So therefore, there is always a credit risk or bad debts risk that you will have whenever you deal with the market. Foreign exchange risk is an inherent one. You see the way US dollar appreciates as against the Indian currency, or even for that matter pounds. Whenever you transact between cross countries, there is always an inherent exchange risk, which could always be minimized by entering into a hedging transactions. But nevertheless, to some extent, you will always have this foreign exchange risk. Capacity utilization is to what extent I am able to utilize my resources. Either it may be in the form of usage of my production line, or if I am into the business of service, to what extent I minimize my bench strength, underutilization of the bench strength. So this becomes critical. This is some of the aspects, but as we move into each of these industries with regard to manufacturing, distribution and services, how these sort of functions, risk and assets plays an important role when it comes to characterization of a particular company. Now, if you look at the framework of risk analysis, OECD transfer pricing guidelines have given you a 6-step approach. 1. Identify what are all the significant risk from the transactions, like how we have identified here. For example, now I have to identify the risk that are associated with a particular transaction. Now, from a contractual standpoint, understand how the risk allocation has been done between the parties. Who assumes which sort of a risk? Generally, risk follows person. Risk is what will give you a return. Say, for example, if I undertake more risk, then there is always a notion that I have undertaken risk. So if there are significant profits that comes from a particular business, I will only be entitled to that significant profits. If someone has not taken significant risk, why I should attribute significant profits to the person who has not undertaken the risk? Another critical aspect is, merely because the contractual term says that A will assumes the risk of this particular transaction, doesn't mean we should stop with that. We should say whether that person has actually taken decisions or undertaken functions to assume that particular risk. Is he capable enough financially to assume such a risk? If he is not capable enough to assume such a risk, then he may not be entitled to that particular return. We will look at it in a later point. How does this particular element works when it comes to risk aspect? So I have to bifurcate these transactions in such a manner from a contractual terms and from substance, identify who performs what functions, how the risk travels through the functions, and who assumes the risk contractually, but in substance whether that person is having a capacity to assume such a risk. This is just a example with regard to some of the control and risk with regard to the financial capacity. We will look at it in a while as we go into the functional aspects. We have some examples over this particular aspect as well. Now, to illustrate an example, software product company enter into a new technology or a platform development. Now, what could be the risks that are associated with this? 1. What is the market needs with regard to a particular technology? Now, if you, for example, you look at the moment ChatGPT came, you have various other search engines that have come. You have a DeepSeek and you have a Grok. There are so many. Now you have Perplexity. So, to what extent they are able to identify the market potential and what is the market demand, what exactly the market requires. Without this assessment, your product fails. Now, possibility is, this is one of the important aspect when it comes to a software related aspects. What does the market demands? What is the current trend of the market? Now, what is the timeline with which I have to roll out the product? Because the way in which the new technologies that are emerging, you look at any shift in your pilot to actual commercial exploitation timeline, the life of the software, you have to be on top of the timeline, because if once you miss the bus, there is always a new technology that will overtake the existing one. So therefore, one has to look at, we have identified, okay, with regard to the software product or a new technology, these are the critical risks that are available. Now, who undertakes the decision? I may engage a third party to give me an assessment with regard to the idea which I am proposing. The third party has given me a research report that this is the exact requirement of the market. This is where you can introduce the product and monetize it. This many potential customers are available for this particular technology. Now, who decides, okay, let's go do a development of this particular software, and this is the timeline with which I have to enter into the market. That person controls the risk. If I am outsourcing that particular development also, not necessary, I may have a particular technology team to develop the software. I may engage, let's say for example, Infosys to code me the particular software. Now it is me who are decided that I don't want to do this in-house. Rather, I will do it outsourcing. I will decide what are the parameters of outsourcing. So therefore, I am the one who are responsible. Classic example is our income tax filing software. Government has subcontracted this to Infosys or in some of the cases Tata Consultancy with regard to MCA and other aspects. Now we don't go hold a responsibility towards Infosys. It is the CBDT responsibility to have the software in place for smooth and efficient filing of the returns. So therefore, the CBDT is the one who has decided to subcontract the work to Infosys or other entity. So therefore, they are the one who are responsible for any failure or any other aspect of the decision. Take another example of distribution of branded goods. What are all the economic risk if you look at? One, I have to build the brand in the market. Second is also on the product. Similar to what we have seen in software technology, here I have to create the awareness of a particular product. So therefore, how do I create awareness? It's through various marketing strategies. So what and all marketing strategies I could employ is through medium of engaging the marketing strategy. One, I can go do an advertisement in newspapers, but nowadays how many of us read the newspapers? The reach is not so long. Do it through other social media networks. Say for example, you open today Amazon and you want to look at a particular product, but you didn't buy that product. But by the time if you look at, you go open Facebook, the same product which you have looked at in Amazon will pops up with some offers. You go to Instagram or other social media networks, it keeps coming. So therefore it becomes a marketing strategy. How soon I can reach the potential customers. It is not now about the quality of the advertisement. Catchy advertisement is one side of a thing which will come in all your TV channels or advertisements, all that. But when it comes to social media, it is all about how fast are you able to reach the customer. Now, how do I decide which medium I should adopt? It all depends on my marketing strategy. So therefore, who undertakes this decision to employ this particular strategy for this particular product line? That person has the control over the risk. Now you look at some of, you see various premier leagues that are happening under different sports. You have Tamil Nadu Premier League when it comes to cricket, and some of the famous companies have bought the a particular city and started playing it. And if you could see some of their jerseys, you could see their logo. Every now and then you look at when a prize distribution happens, you could see behind the banners their logo is being projected. So these are the ways in which people use marketing related techniques. So who undertakes the decision will determine who controls the risk. Why these aspects are critical is with regard to entity characterization. Why entity characterization is relevant is to understand what is the role of each of the entities to decide which entity should be selected as a tested party. While there are transactions between two parties, which party should I take it for the purpose of arm's length testing? Can I do a independent testing of one particular entity, or I have to look at it in a holistic manner? If you look at from a transfer pricing principles perspective, anything with regard to the computation of margins says that whichever entity's information is available without any deficiency, in a colloquial manner, information is available, reliable, and then the third aspect is they are the least complex entity. So that particular entity should be selected as a tested party to evaluate your arm's length price of the transaction. Now from a manufacturing perspective, if you look at, I can bifurcate them into different buckets. One, I could be a toll manufacturer where my job is only to do manufacturing. I will not procure any raw materials. I will have only the required tools to manufacture. Whatever is the raw material that are required for me to manufacture are supplied either by the other entity, or they may say go to a particular supplier of mine, get the products, manufacturer. So acquiring raw material also, it is not my responsibility. And you have a contract manufacturer or a job manufacturer. Licensed manufacturer is one situation. I don't have technology to manufacture. I may have to rely on someone else's technology to manufacture the goods. Then an entrepreneurial entity where I have everything. Distributors, if I were to bifurcate it, it could be a commission agent or it could be a limited risk distributor. Someone call it as a LRD, full-fledged distributor, or a value-add distributors. So bifurcations are there. Service provider, if you look at, it could be a captive entity or a limited risk-bearing entity or an entrepreneurial entity. Now, if I were to place them with regard to the risk and rewards matrix as to who will get what sort of reward because of the risk that they control. If you look at toll manufacturer, will be at the low end of the spectrum. Why? Because my functions are pretty limited. I don't own technology. I only have a limited resources of manpower and required assets, plant and machinery to manufacture a particular product. Raw material acquisition, I am not responsible. So therefore, my role is limited to production scheduling and manufacturing. Production scheduling is also depend upon the quantity requirement that are given by the other entity. They will give me the raw material. I simply use that raw material, manufacturer. They will give me the technology. I will do it and then giving it to them. So therefore, my work is limited. My risk is limited. Why? Because I am not the one who is going to the market to sell the goods. I manufacture, giving it to the same person who has given me the raw material. It is his responsibility to go and sell the products. So therefore, my functions are limited, my risks are limited. Same with regard to commission agent. Now look at the commission agent versus contract manufacturer. Risk is slightly on a higher side. When it comes to commission agent, only if I identify customers, I will have my remuneration. Without any identification of customers, I may not have remuneration. Alternatively, I may get into a situation of, let's say, a market support services, where I will not go based on commission, rather I will go based on my cost incurred. Let's say, irrespective of identify the actual customers to you, as long as I rendered my work, you pay me. Either you pay me the cost which I incurred with a markup, or you pay me fixed fees instead of a variable one. So therefore, to this extent, the risk varies. Contract manufacturer is one pedestal higher than the toll manufacturers, mainly because they perform functions related to purchase of raw materials. In toll manufacturer, the raw material is supplied by the principal, whereas when it comes to contract manufacturer, the raw material may be acquired by the contract manufacturer themselves. But they don't own any technology. Technology is being given by the principal entity. And they don't go to market. Essentially, I manufacture and I give the goods back to the principal. It is the principal entity which goes to the market and sell the products. Licensed manufacturer, again you put them in one pedestal above contract manufacturer, because they do all this function of acquiring raw materials, manufacturing. Two different aspects, if you were to compare them with contract manufacturer, is one, I take the technology for manufacturer, but I will sell the goods in the market. I will not sell it back to the principal. If I sell it back to the principals, then essentially I may become contract manufacturer. But here I go to the market and have a customer facing entity. Except for the fact I don't own technology, rest I will do everything. A principal manufacturer or entrepreneur, it's an entity, is a situation where they do everything for themselves. I have a technology, I have my assets, I manufacturer, I go to customers and sell the products. So if I were to put this into different buckets, with this slide we will break for a moment. So if you look at critical aspect is on intangibles. Toll manufacturer relies on principles of for technology, same with the contract manufacturer. Licensed manufacturer also, but the technology is not to manufacture on behalf of the principal manufacturer. I take the technology for exploitation in the market. I get the license, I manufacture, I will sell it to the market. Whereas the full-fledged manufacturer, if you look at, he owns intangible. Title to products, if you look at, toll manufacturer, no title. Contract manufacturer takes title because I purchase raw material, manufacturer, and then I sell it to the principal. So with regard to these three aspects, I takes title. Volume, if you look at first two contract and toll manufacturer, the manufacturing production is depending upon the requirement that are given by the manufacturer. But when it comes to licensed manufacturer or the entrepreneur, it always on the market. So therefore I may have significant stocks with regard to this particular entity. So we were looking at the characterization of manufacturers and what are the functions that they perform. If you look at functioning of functions with regard to R&D, could see on the extreme right where the entrepreneurs perform major functions of R&D because they are the one who owns the technology. Licensed manufacturer may perform some limited functions, that is to cater the specifications in the local market, while the technology may be there in the overseas market. But you could always see, classic example is the manufacturing of cars, where due to local conditions they may tend to modify to some extent. So to this extent, the right of exploitation is taken and some modification to customize your local requirement can always be performed. Raw material procurement, if you look at a toll manufacturer does not perform any functions because the raw material has been given by the principal manufacturer either on its own or through the designated suppliers. Whereas licensed manufacturer or full-fledged manufacturer, if you look at, they perform highest of functions. With regard to contract manufacturer, it may be limited because sometimes majority of the vendors who will be supplying the product are designated vendors. So therefore I don't have to go and look at the vendor quality related controls or raw material control aspects. All these are undertaken by the principal entity. Based on their directions, I go and purchase them. So these are some of the critical functions that may exist between different facets of manufacturers. Risk profile, if you look at from a toll manufacturing side, the risk is very minimal with regard to all other aspects. I don't do R&D, so therefore no R&D risk. I don't go to market because my supplier is the principal manufacturer, principal entity. I don't stock inventory because I manufacture based on the quantity that are determined by the principal manufacturer. There is no product liability risk. Credit risk will be there. To the extent there is a delay from the principal manufacturer, I may have a credit risk. But business risk, I may have a significant exposure because tomorrow if the principal manufacturer does not give me any furthermore contracts, whatever the investments that I have made in the operations will have a significant risk. So I'm exposed to a business risk. From a contract manufacturing perspective, my market risk could be medium because I don't actually access the market. It is through the principal manufacturer I am accessing the market. If there are any issues with the principal manufacturer, then to the extent there is a replica effect will be there on me. So to the extent there is slight exposure is there. Inventory risk, I do undertake inventory risk because I purchase products, stock it, manufacture it and deliver it. So to this extent there is a inventory risks that are available. Likewise, general business risk is there because I am relied more on my principal manufacturer to place contracts. With regard to licensed manufacturer, if you look at, I have all the risk except for the R&D risk because I am getting the technology from another entity and I am doing the production. So to the extent if there are any research or other failures or any technological downgrade, it is that particular risk is with someone else, but I may have an incidental risk with regard to other products. Now if I look at the characterization of distributors. I can bifurcate them into 3 buckets. One, a sale agent. Like I said, a sale agent could be a commission agent or a market support service provider. Depending on my remuneration model, they may either be a commission agent or a cost plus service entity. My essential role is to connect the customers and the sellers. If my remuneration is based on my commission, then it is essential I integrate myself into the relationship of the seller and customers, ensures that they enter into a contract, because my remuneration determined based on the sales that are made by the seller. Otherwise, if it is I'm going to be a market service provider, my role is very limited based on the guidance and supervision that are provided by the distribution entity. They say you go and market these products, go and approach these sort of a customers and explain about the products. My roles ends there. Subsequently, whether the customers enter into a contract with the seller or not, I am not bothered about it. So therefore, to this extent, my role is limited. So therefore, my functions will also be limited. A limited risk distributor is once a person where I may not significantly stock my goods. I go to a customer says I want to purchase X amount of quantity of a product A. Now I go to the manufacturer, say I need product A of this particular quantity. You give me this quantity. So based on agreed contracts with the customers, I approach the manufacturer, purchase the goods and then transfer it. For a limited period of time, I may have inventory. Say for example, 31st of March, I may have some existing contracts for which I have to deliver goods. In the books, I may have inventory, but in reality, I may not have, because most of the situations in LRD, the products are directly diverted from manufacturing to the ultimate customer destination. So therefore, you don't hold the inventory. So therefore, you don't need any warehousing related activities to stock the goods. So that is why if you look at it is called as a limited risk. The titles are flash. Like we had this concept of high sea sale, right? Before the I import a goods, but before the goods reaches the Indian territorial waters, I enter into a contract with the ultimate customer and I transfer the title. What I simply do, I transfer the title which I own. I don't import the goods as it is and then selling it. So if I had imported the goods, then I undertake the inventory related risk of storing it and then delivering it. Whereas when it comes to high sea sales, I merely do a flash title. Same thing what happens in LRD. So even in the context of service, there could be a limited risk distributor. Classic example is our prepaid vouchers of SIM cards. Say for the telecommunication service provider on a wholesale give so much of value of vouchers to a wholesaler. Wholesaler then will give it to the retailer. Retailer then will give it to a ultimate customer. Now essentially the service is rendered by the telecommunication operator to the customers, but in between what happens, it passes through series of chain. Ultimately, let's say for example in a voucher you have a coupon of 1000 rupees. The telecommunication operator will sell the goods to this right to service to wholesaler for 700 rupees. Wholesaler may sell the voucher for 900 rupees to the retailer. Retailer finally sells to 1000. So each of the intermediary will be left with a margin to support their functions. If you look at, they are not subscribing the service and then passing it on. What they acquire, the wholesaler from the telecom provider, is a right to receive service. Same thing is being passed on to retailer, from retailer to customer. ultimately the service is rendered by telecommunication service provider to the customer. So therefore, in this sort of scenario also you have a LRD kind of a concept. Full-fledged distributor is one such where all my marketing strategy, everything will be decided by the distributor. I don't have to rely on someone else's marketing strategy. In a LRD situation, my marketing strategy is determined by my principal distributor or manufacturer, whereas in full-fledged distributor, I alone decide what is the strategy that I want to adopt. I enter into a contracts with the customer. I own goods. I take title to the goods and I deliver goods. So if I bifurcate this into different set of a function with regard to a commission agent or a market support service provider, they only render services. At the best, they may oversee movement of goods between distributor and customer. Beyond that, they don't play any role in acquiring the goods or selling the goods. They only facilitates contracts between customer and distributor or the manufacturer. So to that extent, all their functions with regard to warehousing, distribution, installation, commissioning, billing, collections, everything is limited. They don't do any marketing because it is your own business. You just have to go and approach the customers and then ensures the contracts are binding between the customer and principal. LRD, if you look at, he performs all these functions in a limited manner because warehousing you don't require because you don't stock goods. Sales and distribution, you do perform some bit of work, but it is always at the directions of your principal. You don't make your own decisions or designing your own strategy with regard to how do you want to do marketing, everything. Strategic marketing is decided by your main entity. So therefore, to this extent, all my functions are limited. We will see it in a while how the risk profile goes. So therefore, why they call it as limited risk distributors. Full-fledged distributor is similar to your entrepreneurial manufacturer. Only aspect is they don't manufacture. That is the only difference. From a technology perspective, a manufacturer may have product related technology or a technical know-how, but when it comes to distribution, your brand value holds a significant aspect. Classic example is our fast moving consumer goods related or even Horlicks related Horlicks manufacturer. If you look at, it has been manufactured by a job work person, packing is done, then Hindustan Unilever ultimately sells it. But from a brand perspective, if you look at, you will not be able to resonate with the consumption of product, whereas what sticks to you is the brand Horlicks. You don't even worry about who owns that brand. Ownership of brand is secondary from the perspective of the consumer, but consumer always will connect with the particular brand or a trademark that has been created. So therefore, Horlicks is one classic example where that contributes to the full-fledged distributor. Risk profile, like I said, risk follows functions. Functions follows people. Because people is the one who is going to carry out a function either on their own or through a subcontractor, or they decide. So therefore, functions follow people, risk follow functions. When my functions are all limited, my risk is also limited likewise. So therefore, when it comes to LRD, if you look at, everything is limited. So therefore, the term is limited risk distributor. But they do have a risk with regard to general business. What happens tomorrow if there are no demand for that particular product? Characterization of service provider is similar to it. Either it could be a captive or a normal distributor. Captive will be in a situation where captive also the general tendency to presume Captive means I am risk free. Captive is a term where I don't render services to more than one parties. I may render services only to my group entities, either to one particular entity or the entities forming part of a particular group. So therefore, I'm calling it as captive. I don't have to go render services to various customers. This is one single customer, either it could be a single entity or a group of entity. I could be remunerated on a cost plus or on a hourly basis. This manner of compensation will determine my characterization. Say for example, if I am compensated on a cost plus basis, whatever is the underutilization of capacity will already subsumed as part of my cost, because I would have paid all my employees irrespective of whether they have worked on a particular project or not. So whatever is the underutilization of capacity is already been subsumed within the overall cost. So therefore, when I do a cost plus markup, my entire risk of capacity underutilization has already been subsumed. I am still a captive but a cost plus. But the same captive, for example, I am rendering only two services with regard to a particular entity or a group entity. If I am being remunerated based on the number of hours I have employed or on a fixed basis, there is always a chance that despite you being a captive, you still be exposed to a underutilization of capacity. So therefore, the correlation that I am being a captive, so therefore I am always be a risk-free entity is not sacrosanct. There could always be, depending upon your remuneration model. A captive with a full cost plus markup will be a risk-free entity, whereas a captive with a hourly rate or a fixed may expose to some bit of risk. So this is with regard to the aspect of risk related. Now let's look at some examples as to how do we characterize. Let's look at a scenario 1 where you have a ACO in country A and BCO in country B. ACO owns technology and brand. BCO manufacturers, they do local R&D. They are responsible for sales, management, supply chain, quality, inventory, and they sell the goods to unrelated third parties. Scenario 2, CCO in country A owns technology, product specification, supply chain, manufacturing, quality check, everything. Country B does manufacturing service to meet principal specification and volume requirement. They've been remunerated on a cost plus markup. If we were to bifurcate the functions with regard to who does what, in situation 1, if you look at entity B performs local R&D, responsible for sales and supply chain inventories. So therefore, what would be their characterization if we were to look at from this aspect? Which bucket they will fall? Any thoughts? Will you be regarding them as a toll manufacturer is anyway ruled out? If you look at in the example, there is no movement of inventory from A to B. Right. Scenario 2. Because I manufacture the product and then deliver it back to CCO. Toll depends on. Right. Now let's look at a situation. In this first example, if you look at, both are manufacturer. Right. So each will be entitled for their own returns with regard to. Generally, what happens in these sort of a scenario is entity B generally pays a royalty for use of technology. So therefore, if one were to look at in the entire value chain, right from the having a R&D related functions till the exploitation through manufacturing happens, you may end up having, let's say, 100 rupees is the profit that the entire transaction has obtained. Out of this 100, if I were to bifurcate it, what amount of profits that it should go to A and what amount of profits that it should go to B. If you look at A would be entitled only with regard to the return related to an intangible, whereas other returns are all vested with entity B. So to this extent, there will always be a payment of royalty which has to be commensurate with arm's length. So remaining profits will be vested with B. Now the second situation is, if you look at what I essentially do is only a manufacturing service and I am being remunerated at a cost plus. So therefore, if there is a supply of material that either it comes from CICO or its designated supplier, I may be regarded as a toll manufacturer. Or if I were to go purchase the product on my own, do a vendor evaluation, everything, I may be regarded as a contract manufacturer. The issue that could come up here is what happens in a scenario if the contract manufacturer incurs a loss. Can there be a situation a contract manufacturer incur a loss? Because you are generally a risk-free entity, how can you be in a situation that having a loss? So if there is a loss, then the fundamental is I am doing some bit of higher functions, I bit of undertake some risk which are otherwise not commensurate with a contract. So therefore, is my classification of an entity as a contract manufacturer is appropriate or not? If it is appropriate, can there be a situation that I incur a loss? If it's so, or if it is not acceptable is the point of contention, because this issue came up mainly in the context of COVID, where most of these entities' operations were disrupted due to COVID widespread, and many of the manufacturing entities were closed down their operations. So therefore, in this context, there were issues with regard to the what could be the acceptable level of profits. Now again, the question which comes is, who decides with regard to shutdowning of plants? Who has decided to ramp up the facility of that particular plant? These are critical questions one has to look at. If the decision is of the D entity on an independent basis to do a ramp up of operations, then to that extent it is arguable. But if all the decisions as to how much of investments that D entity has to make with regard to setting up of this manufacturing plant or ramping up of their facility, then to that extent it is not the DCO's decision, it is the decision of the CICO. So therefore, they have to absorb the losses. Now another question that will come is, should they really be a markup on that, or whether the cost to cost recovery is appropriate? There are again some challenges. If you really look at from the revenue standpoint, they've always envisaged that your contractual agreement says whatever cost with a markup, I have to compensate the other entity. It is the parent entity which has undertaken the decision to setting up this plant. So therefore, it is your own decision making which has resulted in a loss. So therefore, if at all any loss that comes should go back to you. So you have to compensate them at a cost plus markup. The other way of argue this case is, okay, I have always went for a cost plus markup on a basis that that fellow renders me a service. The rendering of service happens only if you manufacture the product and delivering it to me. In this case, when the entire factory is being closed out due to some extraordinary circumstances. Where is the flow of service? So to this extent, can there not be a situation of doing a cost to cost recovery with regard to that particular losses? That is a one possible contention that may come. Now another examples, if you look at situation 1, it's more from a distributor perspective. BCO operates with significant authority, procure goods and sell it to unrelated parties. There is no control on pricing. What is the price at which BCO should sell it to unrelated parties? BCO takes titles of goods, bears all related risk. Now again, situation 2, if you look at all the strategic management functions of DCO are decided by CCO. The products are procured on a back-to-back basis based on predetermined customer order. I procure the products and then I am selling it in the market. If you look at the flow of goods, directly goes to third parties. So situation 1, if you look at, it is a case of the full-fledged distributor. Situation 2, it's a case of a limited risk distributor because they don't have any inventory risk. All the orders to CCO is based on predetermined order from the third party and the delivery is directly happening to third parties. One critical aspect is also the strategic functions that DCO going to perform. Whatever is the marketing activity is being determined by CCO. So to this extent, this particular situation falls as a contract or a LRD situation, whereas situation 1 falls under the ambit of the full-fledged distributor. So compensation could also be in the form of, let's say, with regard to situation 2. It could either be return on sales. I will leave a assured markup to entity D. So therefore, they will not incur any losses. Similar to your contract manufacturer where they are doing full cost plus, but here you do sufficient return of sales. But the return of sales should be commensurate, which will cover all the other operating costs that the entity is incurring. Alternatively, return on its value added cost. You ignore the gross profit side of it. See, from a gross profit side, if you look at, you will have sales and you will have the direct purchase cost and whatever is the cost that you have incurred to bring the goods to the delivery location. Rest of that are all your operating cost. You might have your admin team, your sales and marketing team, all other employee costs. So up to gross level, you ignore. Whatever is the operating cost portion that you incur, on that you give a reasonable return. That is what the return on value added cost, because that is the value addition you are making. You are not going to do anything with regard to goods because that has been directly delivered to the customer's location. So you don't contribute anything to the goods. So therefore, why should you have significant profits from the goods? If it is on the return of sales, then to the extent of some marketing related returns also is being passed on to you. So therefore, I will go with the alternate theory that instead of giving you a return on sales, why not I look at a return on value added aspects. This is more from a context of intangibles. When we deal with royalty related aspects or other research and development related transactions aspect, what the OECD recommended, it was there even much before OECD in the form of a circular which was issued way back in 2013, circular 3 and circular 6. In the context of intangibles, what happens traditionally, you don't develop intangibles. If you look at from an India perspective, you had lot of R&D centers, software and other technology development centers. In these sort of companies, you have this particular issue where the Indian entities are regarded as a captive entities to develop the intangible or develop the softwares which are exploited by the parent company. Now the point of issue here is what is the exact role of this R&D or the development functions that are carried out in India. Many a times what happens, whatever the development of softwares or technology that you develop, the specifications and other requirements, the feasibility of those things comes from parent. What happens in a scenario, the feasibility, the initial specifications and other aspects are wholly determined by an Indian entity. Indian entity has an authority to carry out the developments without any supervision and directions of the overseas entity. There is always a possibility of potential shift in the intangible from one country to another country. Right? Development is done by one entity. The other entity simply do a cost plus funding and then take the ownership of intangible, register the intangible in a country where the tax rate is very low. If you look at a classic example is Google, where their intangibles are registered in Ireland, because Ireland offers a significant benefits to intangibles that are registered there. All the royalties and other things generally be upstreamed up to Ireland or Bermuda. So therefore you are able to monetize the exploitation of intangibles that are developed in such a manner. From a group perspective, you pay low taxes. So therefore what the recommendations, there is lot of these sort of structures that are put in place to minimize the effect of taxes from one country to another country. So therefore they came up with this concept of DEMPE, which is nothing but development, enhancement, maintenance, protection, exploitation. Who performs what activities? Depending upon your performance of this activity, you are entitled for return. If I say X is only a funder of a particular R&D, then what essentially that person has done is the funding. Similar to if I go for a loan from a bank, bank has given me a loan. Utilizing the loan, I have carried out some business, earned a profit. Can I say, since the funding is given by the bank, majority of the profit should goes to the bank? Answer is no. Because I have carried out my functions, I have undertaken risk, I am entitled for the return. Bank has given me a funding. Then what is the return related to the funding? Is the interest. Apply this concept here. If someone has merely funded you without giving any inputs as to what to done, without any monitoring of all this activity, then essentially what he done is only a funding. So therefore, can I say he is the owner of intangible? So therefore, future exploitation of that intangible in the form of a royalty should only be accumulated to that particular entity. The answer is no. So therefore, this concept has been used to reallocate the profits. If I'm saying I am the owner, then I have to perform these sort of activities to say I am entitled for all the returns from that particular intangible. If I am not so, and if my bifurcated these activities between multiple entities, mere ownership cannot entitle return to them. Each of this activity that are performed by different entities should also be entitled for the return. So therefore, if you look at, if I have only legal ownership, but funding is done by someone else, I borrow a loan, I fund it, and I purchase the IP. Should I be regarded as an owner? Yes, I am an owner. But you are entitled for all the return? Answer is no, unless you do all this DEMPE related functions. So if I am only a owner, then you will entitle for only routine returns. If you have done only the funding aspect of it, then you are entitled only to a risk adjusted returns. If you have done both, then to the extent my remuneration will include both A and B. But if I perform DEMPE related returns, say for example, one entity A performs funding related aspects, entity B performs ownership, but maintenance of that IP, development of that IP or exploitations are done by someone else, then you take overall return from that exploitation, allocate a portion of return to the entity which has done the funding, allocate the portion of return to the entity that have ownership. Now whatever is the remaining profits, that gets given to the entity which performs this critical functions. So therefore, in the entire value chain, you identify which entity performs which activity and then performs this function. So what happens in this case is, like I said, all the conceptualization of an idea or the decision making related to an idea is emanated from parent. Any loss on that development will also be undertaken by the parent. Whereas here, I am merely doing an execution. If I am not doing an execution, but if I do much more, then I may fall under this ambit of, if you look at here, development is bifurcated between two entities. One which conceives the idea, who ensures the idea has been followed. Whereas the other entity is simply doing an execution of that idea that has been impressed upon them. So to this extent, your return may be automatically consumed in a cost plus. But if it were to be a flip situation, where Indian entity does everything and that entity only doing a funding, then your development is with India, whereas funding is with US. Merely because of your contractual terms, can you say US is the owner? He may be a owner, but is he entitled for the entire return from that exploitation? The answer is no. To the extent there will be a redistribution of profits that will happen to India because they are the original thinkers. So this is just a 6-step matrix which we saw in a different form. This is mainly to look at the intangible side of it. Now comes the critical part. You have international transaction, associate enterprise, subject to an ALP. Now we have FAR. Now, how do I test the price? 92C read with rule 10C says, out of the 6 methods, you have to say whichever is the most appropriate method. Rule 10B talks about some comparability parameters, which is similar to what we saw in the OECD, that what is the characteristics of the transaction, whether it is purchase of goods or services, or with regard to intangibles, or with regard to capital financing, we have to identify. Now, whatever FAR which we have seen between the associate enterprise, we have to identify this. Who performs, what are the functions? See, for each of this item, we will look at manufacturer who performs which activity, which functions. You bifurcate it. Likewise, risk profile you will bifurcate it, and then you do a characterization. Now the moment, let's say you are a contract manufacturer or a toll manufacturer, your parent is a full-fledged manufacturer. Between these two, which is a least complex entity compared to an entrepreneur versus contract manufacturer? Contract manufacturer is a least complex because I perform least functions, I undertake least functions. So therefore, I have to go and test the contract manufacturer because that is what the rules also prescribes. The fundamental TPE also prescribes. One, availability of information accuracy of information, and then third is least complex. So if Indian entity is a contract manufacturer or a toll manufacturer, you will have their financial information available. You have contractual terms that are available. Indian entity is the least complex. So therefore I will go and test the Indian entity. Now when it comes to economic analysis, which method I should select? Before we get into it, there are some fundamental aspects which we have to look at is business model, policy and methods. Business model is nothing but what role which entity will play in a value chain, which we have seen in the form of one aspect of FAR, which is the functions. What assets they employ, what risk they undertake. So will I operate as a contract manufacturer, or will I operate as a entrepreneurial entity or a licensed manufacturer, will form part of your business policy. Transfer pricing policy is the internal document or your contractual agreements which determines how do you measure your compensation. Third is the methodology that you use to test the price which you have set in the TP policy. In the policy you set cost plus 15% should be the ideal markup. But when it comes to transfer pricing method, what you will do? Am I followed the pricing that I have agreed with the related party? Whether that agreed price is commensurate with the market conditions is what being tested. Pricing policy is an ex ante. TP methodology to determine the ALP is ex post. So ideally ex ante, what you are setting and what is the result should be consistent. If there are any deficiency, then there is some issue between the manner in which I execute my pricing policy. Now 10b2, if you look at, these are some of the aspects which we will consider for analysis: contractual term, conditions that are prevailing in the market. Suppose a situation where there are market restrictions that you cannot price the product beyond this particular rate. Then these are critical indicators that you have to be mindful of. Selection of methods, profit level indicators, comparability adjustment, and then testing the price. Comparability adjustment, we will look at it for each method. How does this varies? Then comes the computation of ALP. Selection of most apply the one critical aspect is assessing officer can calculate when your transaction is not at arm's length because of these factors. He can recompute it. One, your pricing is not commensurate with the comparable companies. Second, information or not documentation not maintained as per 92D, read with rule 10D. Information that you have used in preparation of TP study is not reliable or proper. You fail to furnish the TP documentations. So these are 4 parameters basis which the assessing officer can recompute the price. Now what happens if he recomputes it? No deduction shall be allowed under section 10A, 10AA, 10B or chapter 6A on the enhanced profits. Only 10AA is there live, and you have chapter 6A with regard to the ATLA, which deals with IFSC related thing. You also have 115 BAB related. If there are any profits that are adjusted, if you are entitled for any specific deductions, you are not entitled. So say for example, your profit is 100. Assessing officer recomputes the profit as 150. Then to the extent of this 50, you will not be able to claim any SEZ related deductions under 10AA. That deductions will be restricted only to 100. What happens to a scenario where income of an AE, say for example, you pay royalty at the rate of 10% on sales. You have deducted taxes, and the associate enterprise also offers that royalty as an income in India. Assessing officer says 10% you have paid is excess. It should have only be 5%. So to the extent of this 5%, there is an expenditure which are getting disallowed. Can there be a corresponding reduction in income? The answer is no. Because here also 92C clearly states because of an adjustment of a transaction in one AE, a corresponding adjustment need not to be given in the hands of the other AE in India. But under the treaty, you may file a mutual agreement procedure and ask for a corresponding adjustment in their country, not in India. So therefore, say in the same example, I paid a royalty of 100. But assessing officer said 50 should be the royalty. Now the other counterpart entity would have offered a royalty of 100 in India. That 100 cannot be restricted to 50. Whatever he has offered, assessing officer cannot have a power to reduce the income that you have offered. So therefore 100 is what being taxable in India. But if they want to have 50 rupees, then they have to file a mutual agreement procedure and say in the other country, they can restrict this to 50, but not in India. Now quickly on comparable uncontrolled price. It is we call it as a cup method, where price charged for a particular product or services is compared with an independent transaction. Now this independent transaction may be between two different parties, or it may be between me and an independent party. Say for example, I have been in the process of selling this Bisleri bottle. To my group entity, I sell the same Bisleri bottle for 10 rupees. For unrelated party also, I sell the same bottle for 10 rupees. Then there is a comparable transaction. But the comparability should also factors. What is the scale of transactions? I may sell to my related parties, let's say 1000 liters at 10 rupees per liter. But for unrelated party, I have sold only 100 liters. Can this transaction be comparable? So the scale should also be commensurate. And it requires high degree of comparability, because I cannot now compare if, let's say, this is a Bisleri brand. Now for someone else, I am not selling the Bisleri brand, a different brand. Then while what I have sold is the water bottle, same small PET bottle, but the brand makes a difference. So there could be a difference in the price. If this is a material factor, then I have to make suitable adjustment for the difference in the brand. Or for example, same contract I enter into with my related party, say my agreement says you are entitled for a credit period of 3 months. But for unrelated parties, I give a credit period of only 1 month. This is a material difference. So to this extent, I have to adjust it for credit period, the pricing between unrelated and related parties. Only after adjustment, I have to compare the price. Generally, very rarely used with regard to products and services, unless you are able to give a comparable level of transactions. And there are also occasions where dispute arose with regard to cup prices, where in some transactions you may undercharge your related parties. In some transactions, you may overcharge your related parties compared to a comparable transaction. In those cases, what department used to argue was, since I am testing the price for a particular transaction, wherever you have undercharged your AE, there I will make an adjustment. Wherever you have overcharged the AE, I will not make an adjustment, because I don't have powers to reduce the price that you have charged. But if you look at the rule 10b, it also talks about aggregation principles. Price charged for a transaction or transactions. So therefore, one has to look at it in a holistic manner. All the negatives and positives can be aggregated, and if there are any shortfall in the price that you have charged, then to the extent there can be an adjustment. Resale price method is typically used in the case of a distributor where I procure products from my group entities and selling it to a third party. So what I essentially test is the gross margin that the distributor or the reseller earns. If the reseller is earning, if he is doing significant value addition, then to this extent this method may not work. This will work ideally in a case of a LRD where you procure the goods and deliver it. You don't do any value addition. The issue that could come with regard to this is the gross margin related details. One may have to derive it from the financial statements. Generally, what happens if you look at sale price of products that you have done to the third party minus the gross margin, then you derive the price that you are payable to a related party. But in practice, we are doing it in a reverse fashion, that I have a price, I have a gross margin. Whether this gross margin is commensurate with the gross margins earned by the independent resellers. Non-AE's transaction also. See, the problem will also come in that is, what happens if you are dealing in multiple products and only one portion of product is being dealt with an AE. So ideally what we do is, you have the sales details of that particular products. You have the purchase cost of that particular product. Then arrive at the gross margin. Here, if you strictly follow the rule, it says what is the sale price you have and what is the comparable margins, gross margins. You reduce it to arrive at the price that you are supposed to pay to related parties. Here we are doing it in a reverse fashion to use gross margin as a base to compare. Okay, this is my gross margin, let's say 25% in this case. And what is the gross margin earned by independent comparables? If my margin is more, then my transaction is presumed to be at arm's length, because I have earned more gross profits from the purchases that I have made, which means the price I have paid to my related parties are lesser. Cost plus method, again it tests the gross margin, but the only practical difficulty is the manner of disclosure in the financial statements. Now the financial statement no longer contains the direct cost versus indirect cost, where you straight away have cost, consumption cost of raw material in case of a manufacturing entity, and then you have all other expenditures. Salaries and wages is not been bifurcated between manufacturing operations versus trading operations. So to this extent, the usage of this method has comes down from a manufacturing standpoint, but when it comes to services, it can still be used. But pseudo transaction net margin method is what generally been used when it comes to services as well. Profit split will work in the case of a unique intangibles. Like I said, you have this DEMPE functions related where 2 or 3 entities comes together to develop a particular intangibles, where you will not be able to use other methodology to determine the profitability of a particular entity. Rather, you do a combined approach. Combination of approach, you arrive at a profit and then allocate it. Like how we do profit attributions for permanent establishment. You have a profit at the whole and then attribute profits to PE to the extent of functions that they perform. Likewise, you have a combined approach of a profit. Then with regard to each of the entity, what is the functions or contributions that they have done? According to their contribution, you allocate the profits. The allocation may happen at the gross level or a net level. Sometimes what happens, each entity will do a identified functions in addition to contribution to a overall activity. So for that identified functions, you you anyway allocate a returns. For unidentified functions, you do a combined approach where there is a concept of residual profit split will happen. The final method, which is other than the other method, is the transactional net margin method. Predominantly used method, close to 70-75% of the transactions are tested through this particular method, and you have the profit level indicator either based on the operating profits versus cost or operating profits versus sales. Sometimes what we do is we use this method as an incidental or a supplementary method with regard to other transactions as well. Say for example, if someone has taken profit split method or a resale price method as well, a supplementary analysis in the form of TNMM can also be adopted to say gross level this is my position, net level also this is my position, so that any extraordinary cost or something extraordinary income can be eliminated and the analysis be presented at the economic level, at the net level. One important aspect of consideration with regard to this is suitable economic adjustments. I think SRINATH and Harish will cover the issues surrounding economic adjustments. So for example, the capacity utilization which I was referring, right? In case of a manufacturing entity, my market demand during the year may dip. So because of it, I may have a significant underutilization of a capacity. So in the comparables may not have that kind of a dip. Say for example, I am operating at 50% capacity level, comparable may operate at 80% level. So therefore, they will be in a better position to absorb all the fixed cost, whereas I may not be in a position to absorb my fixed cost. So to this extent, there is a material differences. So what generally happens in economic adjustment is, since there is a gap of 30% of utilization of capacity, the fixed cost is being adjusted accordingly. And second is, like I said, in case of a volume level transactions, it can be done in your operating margins, or it can also be performed in comparables, both ways. But general practice is to do it in my operating margins, but department always said I will not accept this, you should have performed adjustment in comparables, but it will give the same effect. So likewise, alternative usage of overcoming economic adjustment in the form of underutilization of capacities, performing profit level indicator as a cash profit basis. So what happens is they exclude depreciation from the cost effect. So before depreciation, whatever is the operating cost, from that you arrive at the profit, operating profit, cash operating profit. But only trouble there is you will only eliminate depreciation. What about other fixed cost that you will not have? So therefore, what some of the jurisprudence have looked at is remove depreciation, because that would be the fundamental cause for underutilization. So to the extent I will remove that. Test the profit level indicator with regard to this. So I will remove for both tested party and comparables. You will compare the operating profits. Another form of economic adjustments could be in the form of working capital gaps that you and comparable companies have, that you can adjust it. There are several situations where people have asked customs duty as an adjustment, that I have purchasing all my raw materials from my group entity, so therefore I incur significant customs duty as compared to comparable companies. They are all indigenous purchasing entities, so therefore they will not incur customs duty. So to this extent, you have to give me an adjustment for customs duty is one way of arguments I've made. Forex also people have sought adjustment, because there were after this 2008 depression, the rupee depreciated several proportion in compared to dollar. So therefore, people who are importing goods have to pay more dollars and incurring significant exchange losses. So in those cases, they have said you exclude my forex loss from the operating cost base for you to compute the operating profit. So these are some of the economic adjustments that has been sought by people. And there are occasions, some extraordinary event had happened, like COVID. If you look at in China, Chennai tribunal gave a different proposition that before COVID, my operations are all normal. During the year, my operations are disrupted like anything. So therefore, don't look at this particular margin and take comparables 3 years weighted average. You take mine also weighted average for 3 years and then compare it with the 3 years weighted average of a comparable. While the law doesn't permit to look at that way, but the tribunal out of their discretion gave a proposition that you look at a 3-year weighted average for tested party as well as for comparables, so that any effect of COVID has been eliminated, is what some of the propositions on economic adjustment. Some issues with regard to economic adjustments would be covered in the subsequent sessions. Yeah. So what generally we do in that sense is you have both AE and non-AE, related transactions and unrelated parties. So all people always goes for segmentation. In that case, I will look at only the segmentation of AE. But there is always a dispute between the authorities and the taxpayers as to the presence of segmentation from the audited balance sheet. See, since the overall business, if you look at, possibly be one and the same. One, you're rendering services to related party and another you're rendering services to third party. So therefore, there is no requirement to put a primary segment. Secondary segment is only a choice, country-wise to give. But primary segment, there is no difference in operations. So they always questions that this segmentation is not being audited, so why should I rely on? So we always give a management a certificate or a auditor certificate on segmentation during the course of assessment to say you look at only my A segment where there is a profit. If at all there is a entity level loss, it is on account of the third party segments. That issue is there even in segmentations. At the tribunal level they do, but the assessing officer level or DRP level you always have a challenge. CIT level to some extent they allow this, but at the assessing officer level you always have a challenge if the segmentation is not there. At least recent few years we are facing that challenge. This is a incidental method which are generally used in the context of any unique intangibles transaction or purchase of shares or securities. If you look at the only difference, the wording between the cup and this is, in cup there is an actual transaction, comparable transaction is there, whereas here there is no transaction. Say for example, you would have gone for a quote from the customers. They would have given you a quote. You felt okay, it is not so reasonable, so I might as well go to my related party and purchase it. But this quote could be used in certain situations. Likewise, if you look at the valuation of shares, what they derive is this is a likely price that any independent buyer would pay for your shares, but the actual transaction may not be there. So those sort of situations where other method has been used as a part of supporting the ALP. And if you look at the structure of TP documentation, whatever we have seen from here is, we can bifurcate it into 3 aspects. One, entity aspects, where you have to give the ownership structure, profile, and industry related aspects. Transaction is simple. You have your agreements, invoices, correspondences. If you are using cup, whatever is the comparable prices, all that, and accounts and accounts. Computation related will capture all our transaction terms, the FAR which we have seen, the economic analysis, basis of we selecting a particular method. If you are going with a TNMM or the resale price method, the comparables that we have obtained from the any of the databases, whether it is Provus, Capital Line or ASTP or other international databases, along with your selection and rejection matrices. Why we have selected this particular comparable, why we have rejected this comparable, all that will be captured as part of this documentation. So that's it from my side on the fundamental aspects. This I have just given the relevant rule related aspects, which rule talks about which aspects, which I have highlighted here. I think secondary adjustment, I think SRINATH will handle it. So that's it from my side. Thank you all. If there are any questions, happy to take it, or even during lunch we can discuss. Thank you.
Thank you, sir, for your wonderful session. We'll break for lunch and regroup at around 2. Thank you. Good afternoon, all. I welcome to the second session of today's training. I invite CA SRINATH and CA Harish to the dais. Please be seated. A brief introduction about SRINATH, CA SRINATH. He has close to 14 years of experience. He has worked in engagements pertaining to transfer planning and structuring, preparing transfer pricing studies, handling audits, litigations. He has extensively worked on advanced pricing agreements. SRINATH has experience on working in diverse projects across diverse industries and has handled multiple complex engagements. He also has experience on working in BEPS projects and aligning documentation with India transfer pricing agreements. He has represented clients in revenue audit proceedings before the various tax authorities. He has contributed articles to various forums on transfer pricing. Let me introduce my next speaker. CA Harish Ramanathan has more than 7 years of experience. He has worked on a wide variety of assignments which include advanced pricing agreements, transfer pricing planning, pricing of intercompany loans, guarantees, TP audits and litigation. He has assisted in APA proceedings including preparation of APA applications, responding to queries. He has handled complex transfer pricing litigation assignments including issue of profit attribution to PE in India, exchange of information proceedings, and also represented clients across diverse industry before transfer pricing officer in the course of their transfer pricing audits. He has assisted in representing before various appellate forums including Commissioner Appeals, Dispute Resolution Panel and Income Tax Appellate Tribunal. Warm welcome to you, sir. Now, as a token of our appreciation, we would like to invite CA Bhaskar R to present a motto to our speakers.
Hello everyone, good afternoon. Thank you for the welcome, sir. First of all, I would like to thank SIRC for giving me this opportunity, and of course Mr. SRINATH, who is more than a mentor. He's a friend and a colleague, and who has played a very significant role in my shaping up my career. So thank you, Srinath, for this opportunity. So today we would like to, I will set the context on what we are going to see today. In the first half, Mr. Prasanna sir covered the fundamentals of TP, how it started in 2001, and what are the various implications and the interplay between sections 92A1, 92A2, and what are the various methods and how to compute ALP. So everyone would have a broad idea about what is TP, what is the fundamentals of TP. So here Srinath and I are going to cover the litigation aspect of the fundamentals of TP. What are the various litigation trends that is currently there in the appellate forums as part of our proceedings. So to start with, as you all know, transfer pricing isn't just a checkbox complaints anymore. Like October வந்துருச்சா ஓகே 3CB ஃபைல் பண்ணணும், நவம்பர் வந்துச்சா மாஸ்டர் ஃபைல் பண்ணணும். இட்ஸ் நாட் those compliance checklist anymore. It has evolved significantly. It right from start in 2001 when it was introduced to this day, it has completely evolved, and it's a hot topic among all the tax authorities across globe. So especially in India, where tax authorities have started digging deeper into the facts of a particular case. And it isn't just about say determining a price for a sale or service transaction. So tax authorities have started looking for whether do you have any intangibles, what is the financing arrangement, how you are funding, how you are getting funded, and even more to the aspect of how you are doing your business in India. So that's how the tax authorities have gone deeper into identifying whether you are getting compensated for the functions that you do in India. So given this, what is in store for us is basically there will be more complex issues, there will be more complexities, there will be more audits, TP audits, big adjustments, transfer pricing adjustments, and a plethora of cases before various courts which will be pending adjudication. So given this context, today we would like to cover the key areas of litigation. One is the various time barrings of orders and the proceedings where the appellate forums have decided or quashed an assessment in various tribunals, high courts and Supreme Court, even Supreme Court. And the other key issues in transfer pricing, say for any attested party, management charges, recharacterization of an assessee from a low risk entity to a high risk entity as an entrepreneur, and other intangibles related issues. So before we get into the facts or before we get into the key judicial precedents, we would like to know what is how a transfer pricing audit is done basically. So who are the various authorities, how a transfer pricing audit is done, what is how it can be referred to a TPO. So I will cover the basics part of it by setting up context. So first we will see who are the income tax authorities. So the income tax authorities start right from income tax officer, who is the lowest level of authority in the income tax judicial entire authority level, to the high-end principal chief commissioner, who is the highest officer providing all the approvals and various proceedings across the assessees. So if you see here, each officer is a subordinate to the next officer. Basically, an income tax inspector is a subordinate to the income tax officer, while income tax officer is subordinate to an assistant commissioner, and so on. So, and everyone is a subordinate to the principal chief commissioner. So a question to the audience: is income tax appellate tribunal an income tax authority? Whether an ITAT is considered as an income tax authority. Yes, you are right. So ITAT is a quasi-judicial body by itself, and it is outside the purview of income tax authority, and they would be operating on an independent basis and decide on various ITAT cases. So going on, apart from income tax authority, we have various appellate forums starting from CITA, ITAT, High Court, and the Supreme Court. While ITAT is the final fact-finding authority, the High Court and Supreme Court discusses or covers only the substantial question of law. While DRP is not an appellate forum as such, DRP is just an extension of assessment proceedings. It is an additional benefit given to the foreign taxpayers, and specifically where TP issues are involved. An additional leeway to the assessee for a faster route to the ITAT, the DRP proceedings are given. And apart from this, we have 263 and 264 revisionary petitions, where 263 is where the CITA has a power to suo motu pass an order, which is prejudicial to the interest of the revenue. And 264 is where assessee can approach CITA for a principal chief commissioner or a commissioner for any mistake apparent from the record. While 263, the assessee has an option to appeal before ITAT. The proceedings under 264, where a commissioner passes an order under section 264, the assessee does not have any leeway to file an appeal before ITAT. The only leeway the assessee has is to file an appeal before or a writ before High Court. So moving on, what is a transfer pricing assessment procedure? So how it all starts. So for any assessee, the assessee has to file a income tax return or accountant's report. So it starts from filing of accountant's report, that is Form 3CEB, which will be filed on or before 31st of October, which will be followed by an income tax return, which should be filed on or before 30th of November for cases involving TP. And once the assessee files the IT return, it will be picked for a scrutiny by the AO, who in turn will refer the cases to the TPO, which it involves. There are various criteria under which he can refer a case, which we'll be seeing in the ensuing slides. Once it is referred to the TPO, based on all the documents that we submit, will decide on the case, and he will pass something called as a TP order. And once TP order is passed, the AO, in conformity with the TP order, that is, incorporates whatever is the adjustment made by the TPO in his AO order, and he will pass something called as a draft AO order, which gives assessee an option for filing his objections against any findings of the AO before the DRP. The assessee also has an additional option where, in case he feels he need not go for a DRP, and he is looking at an option of filing an appeal before CITA, then he can make a corresponding request to the AO for to pass the final assessment order, pursuant to which within next 30 days he has an option of filing appeal before the CITA. Moving on now, timelines. So we know who is authorized or how assessment procedure happens. What is the timeline for completion of assessment as per the Income Tax Act? So the timelines are governed by provision section 153, where from FY 21-22, that is AY 22-23, the timeline for completion of assessment is 12 months from the end of the assessment year, relevant assessment year. Say, for example, FY 21-22, end of assessment year is AY 22-23, and 12 months from the end of that assessment year will be 31st March 2024. So any proceedings which does not involve TP cases has to be completed 12 months from the end of the assessment year. Specifically, where there is a TP case, as per section 153, an additional time limit of 12 months is provided for the TPO to complete his assessment. So in that case, for completing the entire proceedings, the timeline would be extended by additional 12 months. So in the given example, say for AY 22-23, the due date for the AO would be 31st March 2024, while if the case has been referred to the TPO, the due date get extended to 31st March 2025. This is for FY 21-22. And the time limit for TPO to pass an order is governed from the final assessment order or the draft assessment order under section 153. The timeline referred is 60 days prior to the due date mentioned in section 153. So as per in this case, the AO gets a total timeline of 24 months for completing an assessment, and it ends on 31st March 2025. And 60 days prior to that, a TPO has to pass his transfer pricing order. So what is the procedure after passing the TPO order? So as per section 144C, which governs the entire dispute resolution panel, the assessee is given an option where the assessee can accept the variations proposed by the AO through a draft order. Within 30 days, he has to give his confirmation to the assessing officer that he has accepted the variations proposed in the draft order. Otherwise, the AO can himself, if there is no such confirmation, or if the assessee has not filed any appeal before DRP, the AO can proceed to pass the final assessment order within the next 30 days. If the assessee decides to file an objection before DRP, then he has to do it within the 30 days from the date of draft order. And once the DRP objection is filed, the DRP will adjudicate on the issue, and the DRP has to pass its direction within 9 months from the end of the month in which the objection has been filed. Once the DRP issues its direction, the AO within next 1 month has to pass his final order in conformity with whatever adjudication done by DRP within 1 month from the end of the month in which he has received the DRP directions. In case the assessee, as we discussed before, in case the assessee does not prefer an appeal or does not prefer an objection to before DRP, he has an option to file an appeal before CITA. Upon receipt of the final assessment order, within 30 days upon receipt of the final assessment order. So next we will see, so we have seen who is the authority, who is the authority, and what are the various procedures that is there in the income tax, and what is the timeline to complete an assessment. Now we will see how a reference can be made from an AO to a TPO. So section 92CA talks about reference to the TPO from a AO. So 92CA1 says that if the AO considers it necessary, then the AO can transfer a case for ALP determination to the TPO with a prior written approval of the commissioner or a principal commissioner. So here there are two conditions. One, the AO should consider it necessary. That is, he should record his findings saying that these are the various reasons for which I am referring the case to the TPO. And after recording his reasons, he has to get a prior written approval from the commissioner or the principal commissioner, saying only upon approval this reference could be treated as a valid reference. Then 92CA2 provides the proceedings after reference. So basically, once the case has been referred by the AO to the TPO will issue a notice under section 92D3 calling for various informations based on which we have, or the assessee have, determined the ALP of a particular transaction. So he may call for various documents, mainly the transfer pricing documentation that the assessee has maintained, financial statements, what is the income tax return that they have filed, and what is the form 3CB, what is the position they have adopted in concluding a transaction at arm's length. So that the TPO will issue under section 92CA2 and call for documents that has to be maintained by the assessee under section 92D3. Section 92CA2A and 92CA2B are later introduced. These sections were not there as part of the initial introduction of the Act and were later introduced in 2011 through a Finance Act 2011, where, so the issue was, suppose say the AO has made a reference to the TPO for a list of transactions, say purchase, sales, all those transactions, and during proceedings, during the TP proceedings, the TPO identifies that the assessee has missed out on a certain transaction to report in Form 3CB. In such a situation, there were decisions, or there were issues pertaining whether the TPO has a power to determine ALP of such transactions, say which is not reported in 3CB and which is also not referred by the AO in the first place, whether TPO has a power or jurisdiction to determine the ALP of such transactions. So given that till 2011 this was not introduced, and in Finance Act 2011 the government introduced this section to say that yes, TPO can determine ALP for such transactions, even though it was not reported by the assessee in the first place and not referred by the AO to the TPO. So that section covers 92CA2A and 2B. 92CA2C gives a stoppage of where the AO can reopen an assessment based on finding that say a particular transaction has been missed out in the reporting in Form 3CB. So the timeline given is 1st day of July 2012. So basically any data or any transactions pertaining to the year prior to 1st day of 2012, then those transactions cannot be a reason for reopening an assessment. So the last point is on the transfer pricing officer. They are generally deputy commissioner. So when we saw the various income tax authorities, transfer pricing officers start from a deputy commissioner, DCIT, deputy commissioner of income tax, or he can be a joint commissioner or an additional commissioner. And the deputy commissioner will have a reporting, or deputy commissioner is a subordinate to the additional commissioner or the JCIT, joint commissioner. So moving on, 92CA3 covers the order to be passed by the TPO. So the TPO passes based on whatever documents we have submitted, the assessee has submitted. Based on that, the TPO undertakes, verifies all the documents and determines an arm's length price and passes an order under section 92CA3. And as we discussed below, 92CA3A gives the timeline within which the TPO has to pass an order, that is 60 days prior to completion of 60 days prior to the limitation referred in section 153. 92CA4 talks about the powers of AO in incorporating whatever adjustments TPO has made, and it says that the AO can not alter an adjustment what a TPO has made, and he has to just incorporate whatever adjustments TPO has determined or whatever ALP TPO has determined in his draft assessment order. 92CA5 and 6 provides powers to the TPO to rectify any mistakes apparent on record. Say there are mistakes apparent on record in TP order, the TPO has powers to rectify such mistakes. 92CA7 provides the powers for TPO, wherein say 133(6) he can issue notices to various companies, assessees, requesting for all details. 92 section 133A where the TPO has the powers to undertake a survey, and 93(1) regarding any discovery or production of evidence. Finance Act, so moving on, Finance Act 2025 introduced the concept of block assessment, where it gives an option for the assessee to, if the assessee exercised that option, a period of 3 years together, the TPO can determine an ALP for a period of 3 years together. So 92 CA 3B gives that option to the assessee, and if such option has been exercised by the assessee, then the TPO will pass an order confirming that the option is valid and the assessee has exercised its options within 1 month from the end of the month in which such communication has been received from the assessee. The thing is, currently no forms has been prescribed, no forms or the manner in which the assessee can exercise this option has been prescribed by the Act, and we are looking for maybe by the next Finance Act we would be able to get some details on this. And this is applicable, or this provisions are with effect from 1st April 2026. That is, any proceedings or any TP proceedings that is happening after 1st April 2026. So currently the assessment year that is going on is AY 23-24 before the TPO, for which the due date is 31st of January 2026. And any reference for the TPO for AY 24-25 should have been completed before 31st March 2026. So the only year which could be covered under a block assessment starts from AY 25-26. So from the year AY 25-26, the assessee will have an option to select, to exercise this option of doing a block assessment for 3 years put together. So 92 CA 4A discusses about how the ALP to be determined for the next 2 years. So to give a practical example, suppose say AY 25-26 is the first year of reference, and the TPO and the assessee exercise that option of doing a block assessment, and the TPO also validates it by passing an order confirming the option. Subsequently, the TPO will pass an order. Whatever is the ALP determined in the first year, year 1, same manner he will determine the ALP for the year 2 and year 3 and pass it to the AO. And once the AO receives such order, upon completion of assessment of the respective years, say year 2 and year 3, the AO within next 3 months has to pass an order incorporating such ALP adjustment as determined by the TPO. So that is provided, the powers of AO is provided under section 155(21), and the power of TPO to determine the ALP for year 2 and 3 is governed under section 92 CA 4A. So the other aspect here is that, say suppose the assessee has exercised this option, whether any reference has to be made by the AO to TPO again for the year 2 and 3 is the next question, and the answer is no. This is covered by a specific proviso to section 92 CA 1, which provides that if the assessee has exercised that option, then no reference need be made by the AO to the TPO. And in case, say, the assessee, the TPO AO has already referred a case to the TPO, it will be considered as non-existent. So this is the amendment or the update with the Finance Act 2025. Moving on, what is the basis by which the TPO can select a case for scrutiny, or the AO can select a case for scrutiny, or can make a reference to the TPO? So this is governed by instruction number 3/2016 of CBDT, which provides for various criteria or risk-based parameters under which AO can refer cases to the TPO. So if you see here, cases to be selected based on account of TP risk parameters. So the government for now have not what are the various TP risk parameters. that is not available in public domain, basically to avoid any duplication or avoid any implications from the assessee side, manipulation from the assessee side. So that this data is not publicly available as to what are the various TP risk parameters. And once, if a case is referred under a TP risk parameter, then the AO has to take up prior approval and then transfer the case to the TPO. If the case is not referred on account of a TP risk parameter and it is based on a non-TP risk parameter, then the instruction provides a list of cases or situations under which a AO can transfer the case to the TPO. So here, if you see, the various situations are, say, the taxpayer has not filed Form 3CB or missed out reporting a particular transaction, or the taxpayer has qualified a certain transaction that it is not an international transaction, and there is a transfer pricing adjustment in the prior year of more than 10 crores, and for which an appellate authority has upheld such addition. So only in such a situation, the AO can refer the cases to the TPO. And here again, say he is referring a case for a non-TP risk parameter, that is any one of the following. He has to record his reasons of what is his finding, and based on that reason, he has to get a prior written approval from the Principal Chief Commissioner. So moving on, say suppose the AO has not followed the instruction provided under instruction 3/2016, what will happen to the reference and subsequent TP order? So this has been squarely covered in case of Sava Healthcare, wherein, so to give a brief case, so what has happened in this issue is that there was an adjustment of more than 10 crores in the prior year, for which the AO has passed a draft order and assessee has preferred an objections before DRP. And it was pending disposal of DRP, and before the DRP passes its direction, the AO referred the case of the subsequent year under this category to the TPO. So the court here held that, as we saw in the previous slide, there should be adjustment and it should have been finalized by appellate authority, or the appeal should be pending before an appellate authority. But in this case, what has happened is the AO has passed only a draft order and it is not the finality. It has not reached any finality and the case has been pending before DRP. So the tribunal held that the reference is invalid and accordingly quashed the entire proceedings of the subsequent year. So this gives the essential that the AO should compulsorily follow the instructions that is given under section 3 instruction under 3/2016. Tribunal, Pune ITAT. So in 2023, the government started issuing guidelines to income tax authorities where a case must compulsorily be selected for scrutiny. It gives a various lists of case where there is a search and seizure, where there is 133A survey. So it gives a various criteria. And one specific such criteria is what you can see here now, which says that where there is a transfer pricing or any adjustment, income tax adjustment in the prior years exceeding 50 lakh rupees in cases of a metro cities and 20 lakhs in cases of non-metro cities. And additional condition is that this has become final. Say suppose there is an adjustment in the prior year and the assessee has not preferred any appeal against such adjustment. He has accepted the adjustment and paid off taxes. Even in that situation, a case should be selected for scrutiny, and say the assessee has preferred an appeal and such appeal is pending before appellate authorities. Then even in such situation, the cases should be selected for scrutiny. Next, we will see what are the powers of TPO. So as we see, the powers of TPO are squarely covered under 92 CA, which we saw the various powers. The main object of TPO is that he has to determine the ALP. So once a matter is referred by the AO to TPO, he has to determine the ALP of the international transactions for which the reference has been made. Then the further situations covers whatever rejected. Say what is the, say suppose the assessee maintains a TP study, and under what situation the TPO can reject is quietly covered under 92C3, which gives a list of clauses. Only if the assessee fails to satisfy these conditions, then the TPO can reject the TP study that is maintained by the assessee, or do a fresh benchmarking to determine the ALP. So, and that is a mandatory clause to say that, say suppose there are plenty of judicial rulings which says that if the TPO has not satisfied that the assessee has not satisfied these conditions that is mentioned under section 92C3, then any adjustment or the rejection of TP study could be considered as invalid. And as we saw earlier, the TPO has power to determine ALP of transactions which was not referred or which was identified during the course of proceedings. And next part is TPO has the powers to issue penalty under section 271G. Say that he has identified some issues with reporting of some transactions. The assessee has failed to report some transactions, or the assessee has misreported some transactions. Then the TPO has power to issue penalty under section 271G. And similarly, the TPO has the power to rectify any mistakes apparent on record. So this is what we saw just before. Does the TPO has the power to reject the transfer pricing study report maintained by the assessee? And this has been squarely covered in the Philips Software Center Bengaluru ITAT case, which specifically refers to section 92C3, wherein it provides a various list of clauses which the TPO has to satisfy himself in record that the assessee has failed these conditions, basis which he has rejected the TP study of the assessee. So moving on, so this is broadly about the assessment procedure, the TP assessment procedure, and what are the various powers of the TPO. So in summary, now the cases are not getting selected for scrutiny based on the value of international transactions. It is morely based on the various risk parameters, which is in public. The government has its own way of selecting various cases for scrutiny. And the TPO has, like we said, the TPO has jurisdiction even in case a transaction is not referred to him by the AO. That we saw in 92 CA, CA 2A and 3A. Similarly, any reference to the TPO, mandatory approval of commissioner or a principal chief commissioner is mandatory. Mainly because if there is no such approval, then the reference could be treated as invalid. So, yeah. Yes. No. So to give an example, suppose the assessee has filed a 3CB and has not covered a particular transaction in 3CB, has not reported a particular transaction in 3CB, and the TPO during his proceedings finds out this transaction, even though in the first place when the AO referred the case to the TPO, this transaction was not referred by the AO. Now the TPO has the powers to determine ALP for such transaction. That is what covered under 92 CA2A. That it gives a power to the TPO to adjudicate on or to determine the ALP of that particular transaction, even though it was not referred by the AO in the first place. Yes, yes, not required. So if during the proceedings he finds out that there is some transactions which has been missed out in reporting in 3CB or which was not referred by the AO, he gets materials to prove that there is such transaction exist, then he has the powers to determine ALP of such transactions. So I will take a pause here. Do you have any questions I can address in it? So there are various compliances to be undertaken for TP. One is Form 3CEB. Even if you have 1 rupee of international transaction, you have to file Form 3CEB, which is nothing but an accountant's report. That is to be filed before 31st of October. The next, the 3CEAA or 3CEAC or 3CEAD or something called as a BEPS action plan, which the government has incorporated. 3CEAA is the master file. So if it has a twin condition. So if the group turnover exceeds 500 crores and the value of international transaction exceeds 50 crores, then you have to file 3CEAA, and the due date for that is 30th of November. In value of international transaction between the assessee and the group companies, 50 crores. 3CEAA. It's a master file. It's called as master file. 3CEAC is nothing but a country by country reporting. So across globe, the BEX Action Plan 13 introduced something called as CBCR, country by country reporting. And it is applicable only to entities which exceed the overall consolidated revenue of 6,400 crores. So currently India follows a 6,400 crores. Across globe, it is based on, say, it is USD $750. So if a consolidated revenue of a group exceeds 6,400 crores, then form CBCR, Form 3CEAD is applicable. Suppose, say, the group is filing a form, this CBCR in their jurisdiction, then Indian entity has an exchange of information with such jurisdiction under the DTAA. Then the Indian assessee can file Form 3CEAC, which is just an intimation to say that my so-and-so group in so-and-so country is filing this form, which you can get it from them under an exchange of information. So 3CEAC is more like an intimation form. It's just an intimation form to say that I am part of so-and-so group and this entity of the group is filing the CBCR in that respective jurisdiction. Yes. So it's the contents of the form or the contents of CBCR is same across the globe. You need to submit various, what is the profitability in each of your jurisdiction. It contains a various list of data. Suppose you are an Indian group, Indian multinational entity, which is headquartered in India, then the responsibility falls with the ultimate parent entity of that group. So if it is an Indian ultimate parent entity, then that entity has to file in India, which will be the Form 3CEAD. Yes, across the globe. So including all subsidiaries, consolidated revenue of 6,400 crores. Not required. So the government has enabled something called as exchange of information under DTAA. So says countries like Singapore, USA, the assessee or the government of India has a exchange of information leeway through which it can exchange information between this Indian authority and the US authority. So basis which if US group or the entity which is ultimate parent entity is in US files the CBCR, then India can get it from that entity. To enable that, we have to file a intimation in India to say that I am forming part of so and so group and this group is filing the CBCR in US. Yes, only if they want an assessment of this particular entity, they can enable through this Form 3CAD, they can enable to get all the returns. It's not necessarily that whenever we file a form, the department is going to get the data from the code. Yeah, that is 3CEA. Yes, it's not required. Yes, the only part is 3CA has two parts, part A, part B. So part A is mandatory to be filed irrespective of whether you satisfy that condition or not. 50 crores if you exceed 50 crores. If you are part of an international group, then you have to file part A. For part B, the twin conditions of global ultimate consolidated revenue of 500 crores and turnover of 50 crores. Yes, if the consolidated turnover is exceeding. If an entity is part of a group which is in two different jurisdictions, then Form 3CA would apply. Yes. 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 It is based on the system and it is not available to public. So the government may avoids giving this information in the public just to avoid any manipulation. Say they say this is the criteria basis which they will select case for scrutiny. There is a chances that the assessee could suppress those information without giving to the TPO. So that is the reason they don't give what are the various risk parameters under which they select for scrutiny. No, it is not available in the public domain. Yes, that is internal to the department. Then he will see whether any of these conditions which we saw in the non TP risk parameter. So moving on, next we will see some of the notable rulings that is there on the legality of the assessment proceedings. Say suppose the AO there are procedural lapses in the reference to TPO or in deciding the matter without passing draft order, the AO passes the final order. So what happens in these cases? what is the consequences of these procedural lapses, we will cover in these set of rulings. So here we are covering a list of 6 rulings, right from say what is the period of limitation for the TPO, whether it should be mandatorily followed or it's just a reference from the act. The second is whether passing of draft order is mandatory. Then validity of DRP directions where DIN is not properly documented. The fourth one is time barring of assessment read with section 144C and 153. What happens if the AO does not pass his final order within timeline pursuant to DRP directions? And the last one, comparables issue, whether it is a question of law. So each of this is covered through a particular case law. First, we will see this Pfizer Healthcare case law. It is a Madras High Court case law. So the issue is to give a background. What has happened is the TPO generally has a timeline. So they have an internal system which provides a timeline within which he has to pass his TP order. So the timeline as per TP order for AY 1617, which is the relevant assessment year in this case, is 31st October 2019, the due date to complete the TP assessment. But in certain cases, what happened was the TPO passed the TP order on 1st November 2019. So that became the basis of issue with which the assessee filed a writ before Madras High Court, calling for calling for quashing the entire assessment proceedings because the TP order was barred by 1 day delay. So to explain this, section 92 CA 3A provides a timeline that the TP officer may, underline the word may, pass an order, pass the TP order 60 days prior to the completion of due date mentioned in 153. So here the department took use of this word may and said that this is more like an indicative in nature and not mandatorily to be followed by the TPO. And the passing of order on 1st November is still valid, was the argument that the department has taken. But the courts have categorically rejected it, saying that in certain cases the word may can be read as shall, because if the TPO is not given a definite timeline and said at any time the TPO can pass an order, then it will make the entire proceedings or the entire timelines itself futile. So basis the same, the court argued, the court decided on the matter, saying that the TP order dated 1st November is outside the purview or is illegal and void ab initio and quash the entire proceedings. Since the TP order becomes invalid, consequently the final AO order or the draft AO order subsequently passed by the AO also becomes invalid. So this is the ruling. This is now currently pending before Supreme Court for adjudication, and there are almost thousands of cases which is basis which this 1st November issue is pending before the Supreme Court. So we need to wait and see what is the adjudication from the Supreme Court. So the next is draft order mandatory to be passed? So this is squarely covered in Vijay Television, again a Madras High Court case, where in this situation what has happened is the TPO passed his TP order, and the AO pursuant to the TP order, instead of passing a draft assessment order as stipulated under section 144C, passed the final AO order. Later on, he realized that he issued a final AO order and issued a corrigendum to the AO order saying that please consider this as a draft AO order and not the final AO order. So even in this case, the High Court categorically rejected the said corrigendum, saying that as per the Act, the TPO or the AO must definitely pass a draft assessment order, and subsequent issuance of corrigendum will not cure the major defect of issuing a final order instead of a draft order. So the court finding is corrigendum cannot convert a final order into a draft order, and such defect is not curable. Draft order is a statutory safeguard, and skipping it deprives the assessee of the right to approach the DRP. So since the AO passed the final assessment order, the assessee is losing an opportunity to object the various finding of his AO before a DRP. So this violates the principle of natural justice, and accordingly, the final AO order passed by the AO is considered invalid or void ab initio. Moving on, DIN. So document identification number is introduced by the government in 2019 via circular 19/2019. It mandate categorically says that any communication from the department to assessee should contain this document identification number. So suppose say there is a letter or a issue notice from the income tax to the assessee, it should mandatorily mention a DIN number, which will be a series of codes, which is an identification for the department to say that this is an authenticated document that is coming from the department to the assessee. And this circular 19/2019 provided this, that any communication from the department to the assessee should contain this DIN, and in case the department does not issue a DIN identified document and it issues a manual order, then it should get an appropriate approval from the CCIT or the Director General of Income Tax. And even in such case, within 15 days, a DIN should be issued categorically for those such documents. And the assessee can check the validity of this DIN by keying this number in the income tax portal that is available for the assessee, and he can check whether this document is an authenticated document issued by the department. In case if you key in the number and it does not show up any record, then such DIN can be considered as invalid, which makes the document or any communication or orders from the department as invalid. So taking this cue, there were a plethora of cases that was filed before the income tax tribunal on this very ground, that the documents without DIN should be considered as invalid, and the circular 19/2019 should be strictly followed. So the background of this issue is that till date DRP directions are issued manually, and what the DRP does is that before passing of a DRP direction, they will generate a DIN document using their ITBA portal, and they will manually key in this DIN on the face of the DRP directions. Apart from this, they also had a practice to issue a notice or a document as a covering letter to this DRP direction to say that the DRP directions with so and so DIN is issued on so and so date, and that covering letter had a separate DIN as well. So, but what was the issue is that in most of the cases, the DIN number that is mentioned in the notice, that is covering letter of DIN so and so of DRP direction, was not matching with the DIN number that is mentioned in the face of the DRP directions. So taking advantage of this, the assessees filed appeal before tribunal, followed by the High Court as well. And both tribunal and the High Court have categorically considered that any document has concluded that circular 19/2019 should be strictly followed, and any documents without a valid DIN can be considered as an invalid document or no communication at all. So accordingly, adjustment of around 1.25 billion crores of money has been pending adjudication before the Supreme Court on this very issue, because there are plethora of DRP directions which has been considered as invalid, making the entire assessment invalid and quashing the assessment orders thereon. So this case, the similar ruling in case of Brandix is pending before Supreme Court, and Supreme Court has provided an interim relief to the department, categorically mentioning that not mentioning DIN in assessment orders may be an irregularity, but does not make it an illegality. So it's yet to be adjudicated. The orders are awaited from the Supreme Court. However, currently the department has a stay on this very issue that is pending before Supreme Court. So moving on, the other important or a significant issue that is there before the Supreme Court right now is the Roka bathrooms issue. So we will just give the brief facts of what is there in the Roka bathroom. So it is a remand back proceedings. Basically, the assessee filed the TPO passed the TPO order in January 23, 2013, followed by the AO draft assessment order was passed on March 30, and the final assessment order post DRP directions was passed in January 16. So pursuant to the DRP direction, the assessee filed an appeal before ITAT, and the ITAT issued or remanded back the case to the DRP to freshly examine the issue. That was the ITAT issued its direction, or the ITAT issued its order on December 18, 2015. However, pursuant to the ITAT order, the DRP, neither the AO nor the TPO acted on this ITAT order, and it was pending. There was no communication in so whatsoever form from the department to the assessee. And subsequently, the assessee filed a letter with the AO saying that these proceedings are time barred because there are no communications, and as per section 153, any remand back proceedings has to be completed within so and so time. And the assessee filed a letter saying that it should requesting for a refund, saying that the proceedings were time barred. Subsequent to the assessee filing a letter in 2019, the DRP issued a notice in January 2020 calling for various documents and posting it for the hearing. Pursuant to the DRP notice, the assessee filed a writ before the Madras High Court saying the invalidity of the DRP notice and thereby the proceedings in itself. So before we get into the intricacies of what is there in the Roka bathroom case, we will just go through the provisions of the Act, which is squarely covered under this Roka bathroom, which is provisions of section 153, that is prior to the amendment in 2016. So prior to amendment, there was a section 153 2A, which squarely covered in case of fresh assessment, what is the timeline, and provisions of section 144C. So 153(1) says that in prior to amendment 2016, said that any assessment order should be completed, or any assessment proceeding should be completed within 21 months from the end of the assessment year. 153 2A said that in case of a remand back proceedings where the issue has been remanded back to the AO for fresh consideration, thereby cancelling the original assessment, then the AO has a time limit of 1 year from the end of the financial year in which such order has been received. So if we see in this case, the DRP final assessment, the ITAT issued its order in December 2015, and pursuant to that, the time limit available for the AO to complete this assessment is 31st March 2017. So basically 1 year from end of the financial year. So end of the financial year is 2015-16, and 1 year from that date is 31st March 2017. So ideally, if at all the proceeding should have been completed, any notice to be issued. The AO should have completed the entire assessment before 31st March 2017. And say 153.4 provides that in respect of even the remand back proceedings, say there is a reference to the TPO, then even in such case, the proceedings would be further extended by the 12 months that is available in the original proceedings as well. Then we have section 144C, which says that on receipt of draft order, within 30 days, either assessee can either accept the variation or file objections before DRP. And once DRP decides on the issue, assessee files a DRP, assessee files an objections before DRP. And once DRP issues its directions, within 1 month from the end of the month in which the DRP direction is received, the AO has to pass its final order in conformity with the DRP directions. And it is a non-obstante clause. Basically, whatever is said in section 153, not considering the timeline specified in 153, the AO has to pass a final order in conformity with the DRP directions. So, basis this, the key arguments of the assessee is of 3 scenarios. So, let's discuss each of these scenarios. So, under this timeline, suppose say this here the peculiar issue is that the ITAT remanded back the proceedings to the DRP. So, the first question in itself is whether ITAT can remand back to the DRP, because none of the provisions of section 153 or 144C talks about remand back proceedings to DRP. 153 categorically says that any remand back proceedings to AO or TPO, but it does not talks about DRP. So that was the first issue, whether ITAT remanded back to the DRP, whether DRP in itself can act on such issue. And the second issue is, in case the DRP has to come into the picture of a remand back proceedings, the only way through the act is by way of a draft order. Section 144C categorically says that only when a draft order is issued, it gives the opportunity to the assessee, and only the assessee can approach the DRP. And DRP cannot suo moto pass any directions. So that is the second issue. So considering this, the assessee argued on 3 scenarios. 1, the AO should have passed the draft order as per the timeline mentioned under section 153(2)(a). Considering that there is no other remedy available for the DRP to take up the case suo moto under the Act, the AO should have passed a draft order pursuant to this ITAT order within the timeline mentioned under section 153(2)(a). So in that case, the draft order should have been passed on or before 31st of March 2017. But that has not been done. Second scenario, the assessee argues, suppose say internally the AO makes a reference to the DRP. Say in terms of any communication or any letter to say that so-and-so ITAT order has been received, which has been remanded back to the DRP, and request you to pass your directions or re-adjudicate on the issue. Consider the issues afresh. In such a case, then DRP provisions, suppose assuming that it is covered under section 153, then either DRP should have passed the draft order or the directions, DRP should have issued a revised directions within 30th of March 2017, which has not been done. If we say that DRP is covered under a separate proceedings of 144C, that is 9 months from the end of the month in which a draft order is passed. In this case, 9 months from the end of the, say, the final due date, that is 31st March 2017, after which the DRP proceedings are done, 9 months would be 31st December 2017. Even in that case, no order has been passed. So even in that scenario, the assessment is getting time barred. And the last case is assume a combination of both, where the AO plus DRP plus TPO as well, another additional 12 months, and the timeline gets expired on 31st December 2018. So even in that scenario, the proceedings are getting time barred. So given the same, the assessee filed a writ and argued that in any of such scenarios, either of such scenarios, the assessment proceedings in its entirety is getting time barred, and considering the notice issued by the DRP is in violation of principle of natural justice. The key issues under discussion for this issue was whether the remand back proceedings to DRP covered under section 153(2)(a). Second, whether the timeline prescribed under section 153 covers 144C as well, and whether it refers to a draft order or a final order, because nowhere in section 153 it is specifically mentioned whether it refers to a draft order or a final order. And the last question is on whether DRP proceedings is subsumed within 153 timeline, that is whether 144C is subsumed within 153 timelines. So following the writ filed by the assessee, the single bench ruled in favor of the assessee and quashed the entire proceedings, pursuant to which the department filed an appeal before the division bench of Madras High Court, and division bench as well ruled in favor of the assessee, categorically saying 144C and 153 are mutually inclusive, and any proceedings that has to be completed, the time limits that is mentioned under section 144C should be completed within the final time limit of 153. So basis this ground, so let's give an example of how peculiar or how big is this issue. So as we saw for AY 22-23, the time limit for completion of assessment is 12 months. So 12 months from the end of the assessment year. That means he has to complete 31st March 2024 from 12 months from the end of the month. Then in case there is a reference to TPO, there will be an additional 12 months that is provided to the TPO. Then the due date gets extended to 31st March 2024. If what the bench members have said is followed, then within the time limit of that 24 months, that is 12 months for the AO and the 12 months for the TPO, the entire proceedings of DRP should also be completed. So the AO has to refer the case to the TPO, then the TPO has to pass his order, pursuant to which the AO has to pass a draft assessment order, and the DRP has a 9 months timeline of giving a direction on such order, and after which the AO has to pass a final order. This entire proceedings has to be completed within the 24 months time frame. So that is the outcome of the division bench order in case of ROCA. So plethora of assessees has taken this ground of ROCA, saying that 144C is subsumed within 153 timeline, and any order or any DRP directions that is passed in violation of ROCA will be considered as non-existent or void ab initio or invalid. So pursuant to the division bench, the department filed an appeal before Supreme Court, filed an SLP before Supreme Court, wherein the Supreme Court decided the matter sometime in July this year. So the Supreme Court initially issued a split verdict, basically where the two members had two different views. Mr. Justice B.V. Nagaratna's view was in favor of assessee, while Justice S.C. Sharma was against the assessee and was in favor of the department. So since the members or the justice had different views on the same issue, now the case has been referred to the larger bench, Chief Justice of India, and the bench is yet to be constituted, and it's pending appeals. It's pending disposal by the Supreme Court. So until this issue is resolved at a Supreme Court level, the assessees across wherever they have taken this ROCA ground before the tribunal or the High Court, the tribunal have largely adjourn the cases, saying that it's pending Supreme Court order, and once Supreme Court decides on the matter, then we will issue the order correspondingly. However, recently, the Hyderabad Tribunal, in case of Aveva, issued an order giving a liberty to the assessing officer to reopen the case in case the Supreme Court decides the matter or otherwise. So they have given a favorable ruling. So all this while, ITADs, even in Chennai Tribunal, what we have seen is that they have adjourned the case sine die. But pursuant to this Hyderabad Tribunal, wherein they have ruled in favor of the assessee with liberty to the AO to reopen the case in case Supreme Court decides in favor of the department. So this is the current status that is there, and even many of the assessees recently in Chennai Tribunal requested basis this Aveva ruling that the case be decided so that the funds don't get locked up for the assessees, and requested for early closure of these petitions or these appeals. Yes, sir. Yes, so that is there was a actually it is a peculiar issue. What happened was in 2019 there was a week full of discussion on the tribunal, Chennai Tribunal, which squarely discussed on this issue of whether ITAT has powers to refer the case back to the DRP, because none of the act it is mentioned whether ITAT can refer it to the DRP. But there is a case called India Trimmings, which specifically covers this issue, wherein the tribunal, after hearing a plethora of advocates, decided that ITAT is the quasi-judicial body which is above all of the income tax authorities, and all the income tax authorities will come under the purview of the ITAT. So ITAT in fact has the power to refer the cases to the DRP. Sorry? Yes. DRP, yes. It is not very clear or apparent from the act. It is not very clear as to whether that ITAT can refer the case to the DRP. Yes, exactly. That's where the DRP should have ideally requested or issued a notice to the AO to pass a draft order, pursuant to which the assessee will get an opportunity to file an appeal before the objections before the DRP. AO also cannot act, but at least DRP should have acted, since there is a direct communication from ITAT to DRP. DRP should have acted in this case at least. No, because it is subject to decision of Supreme Court. So in this case, the Supreme Court is yet to decide on the matter fully, whether it is time barred or not. So for now, for closure of assessment, the Hyderabad Tribunal has given a liberty to the AO by filing a miscellaneous application. They can file a MA before the ITAT by reopening the case. Yes. Yes. No. So I will. Yeah. So I will cover that specific part. So the provision specifically says that 60 days prior to the date in which the order has been completed. Just take to the provisions. So the TPO before 60 days prior to the last day. So you should not count the 31st day in. It should not be counted. So 30 days in December and 30 days in November. So makes it 31st October as the final due date. In addition to that, even the income tax department has a internal calendar in which 31st October is mentioned as the due date for completion of TP proceedings. Yes, exactly. Yes. But the act's wordings are said may, and the courts have said that it should be interpreted as a shall, because in case TPO gets more timeline to complete the assessment, then the AO cannot complete the timeline as per 153. No use of having this section. DIN is followed. After this issue of Sutherland before Madras High Court, the DIN has been, in present situation, it's being followed. But that year of, say, AY 2021-22, a list of appeals where the DRP has issued without a proper DIN. So that quantum of adjustment is around 1 point. No, no. DIN is mandatory because the circular specifically says that 19/2019, which specifically says that if any communication from the department without a DIN, it should be considered as invalid communication. So next we will cover time barring of a final order pursuant to a DRP direction. So what happened in this case is that the DRP issued its direction in 24 January 2022, and the same was uploaded in the ITBA portal on 31st January 2022. The AO claimed that he has received the DRP directions only on 3rd February 2022 and argued that he had time limit or to complete the assessment till 31st March. So basically he has 1 month from the end of the month he receives the DRP directions. However, in the assessee filed a writ before High Court saying that the DRP directions was received by the assessee on or before 31st of January, and it should have been ideally completed on or before 28 February 2022. So the main crux of the issue is due to the internal reference of orders, there was a delay in communicating the DRP directions from the DRP office to the AO office. Basically, the AO has received the communication only in February 3rd, making the due date for completion of assessment as 31st of March. But the DRP office has uploaded the DRP direction on 31st in the ITBA portal, which is a 360-degree option that is available with the assessing officer to view any communication that is pending for his adjudication or for its completion of assessment. So here the court held that since the communication or the DRP direction was visible to the AO on 31st of January 2022, he should have ideally acted upon it and completed the assessment on or before 28th February. So we can leverage on these situations where the DRP directions is stated one. However, the AO failed to pass an order within 30 days or within 1 month from the end of the month in which such DRP direction is received. So similar views has been upheld in recent Chennai Tribunal ruling as well, where Multicrore, where India Private Limited also deals with the same issue. The next is comparable issue, whether it is a question of law. So as we discussed earlier, ITAT is the final fact-finding authority, and till now or till this case law, it was of the view that any comparable issue, say selection or rejection of comparables, various filters adopted, all these were considered as a fact-finding issue, and the high courts were never entertaining any of these appeals that was filed by the assessee after a ITAT order. So especially in case of Karnataka High Court in soft branch, the High Court categorically dismissed the appeal, saying that there is no substantial question of law that is involved in case of comparables issue, and accordingly mentioned that there is no perversity based on which the High Court can decide on this matter, and rejected the appeal. The assessee subsequently, in case of SAP Labs, there was a petition before Supreme Court wherein the Supreme Court dismissed this High Court order, saying that the comparables is also governed by the provisions of the Act, and any selection or rejection of comparables contravening the provisions of the Act is a perversity in itself. That is, the High Court can decide on matters which is against the provisions of the law, basis which the comparables were decided. So this is a significant ruling where it gives another opportunity in terms of comparables selection or rejection for the assessee to appeal before the High Court as well. But one cons of having this is that there will be a plethora of cases that is pending before various High Courts. There will be a huge list of backlog of cases which needs to be adjudicated. So that's it from me. So if you have any doubts or any queries with respect to the legality of the proceedings, you can reach out. I will ask SRINATH to cover the key issues in transfer pricing, some of the various key issues. Yes. See, Indian entity is operating as a captive. Okay. So, sir, it all depends on the functional documentation. Basically, what are the functions that you are doing? What are the risks that India is bearing? Vis-a-vis, what are the functions that parent is doing? Suppose, say, the parent, say there is a contract between the Indian entity and the parent, saying that the parent takes care of all the business risk, and India is expected only to service these activities. It decides on almost everything for the Indian entity. Then the Indian entity cannot make losses because I am operating exclusively for the parent. Only in that situation, I can never incur losses. Suppose, say, you are taking some business decisions in India in terms of identifying customers or doing marketing in India, then in that situation, the answers may differ. That is also subject to the conditions of how the entity characterized and how the entity is performing. What are the various functions of the entity in India? Listen. Yeah, absolutely, sir. Yes. But ideally, I have seen from my personal experience, most of the new startups that they give a equal weightage in India as well. So they will say that they share the profits and they share the losses also. They say that they will give India a peculiar set of functions to do themselves that will leave with decisions making in India. They will have a set of people in India who will control and do the business in India. Similarly in US as well. So where they say, suppose the intangible is equally developed from India as well as US, they share the profits as well as the losses of the business. Yeah, that is there. That's where initially in the starting itself, when I'm saying that's why in the case of startup, when they are developing this new intangible or developing this IP itself, they make sure that both entities are equally involved in having this IP register. Because it's been this model of having a captive entity in India and an entrepreneur entity outside India, it's been long gone and more towards they don't want to have one entity making profits and another entity making losses. So they end up having a model where both of them, in case of losses, both of them are making losses, or in case of profits, both of them are making profits. Yes, you it should be properly structured in a way to say that the Indian entity will carry out these functions, and it will bear these risks. Similarly, the foreign entity as well. So it all comes down to the fact that how you structure the agreement, how you structure your business model in India vis-a-vis the globe. Yes, yes. That should be ideally, if you see, ideally it should be based on what level of contributions does India make vis-a-vis the group.
Thank you, Harishi. Let's break for tea. We'll regroup around 3:45. Thank you.
So, hi everyone. So, let's get started with the next part of our seminar. So, uh, Harish would have given you a brief background of how the tax authorities work, the assessment procedures work, and specific case law with respect to the legality. So, how the way the transfer pricing assessment works in the past 2 decades, starting from 2001, they introduced the transfer pricing provisions, and the assessments have undergone a sea change. The issues that were discussed in the assessments, it has evolved over the period of time. So earlier it was more towards your margins, your comparability, but now as the economy is mature and there is a lot of digital economy and other business models change, the issues under litigation also have evolved a lot. Now it is more towards your intangibles, the transfer of intangibles, the DEMPE, the RASI analysis, and there are a lot of changes in the litigation scenario also. So while Harish has covered the legal side of the litigation, I would just want to pick and choose some various 2-3 important issues which are currently under the Indian jurisprudence. So if you see the key transfer pricing issues, generally they have been rotating around or revolving around these kind of issues, kind of what is the selection of tested party, who should be the tested party, then recharacterization, that has been a very important issue which has created a lot of litigation in the recent days. There is an issue called interest on overdue receivables. Intra-group charges, again there are a plethora of rulings in respect of intra-group charges, and entity level versus proportionate adjustments and economic adjustments. I think Prasanna briefly touched upon the various types of economic adjustments, and there are various rulings both within Chennai and all over India dealing with all these nature of economic adjustments. So maybe before I start, wherever who have dealt with transfer pricing assessments or litigations, what comes to your mind when you think about transfer pricing litigation? What issues comes to your mind wherever people have practically seen it? Maybe and throw your thoughts. Around which issue have you seen the major litigation in transfer pricing? Okay, okay, okay. So that's the crux of the issue actually. So there's a lot of litigation around it. Sure. So the first issue that we are going to deal with is exactly on that. What is the selection of tested party? The concept. Who should be the tested party? So basically, there are various literatures around this OECD, UNTP manual, and also our ICAI guidelines on selection of tested party in the transfer pricing. So I think Prasanna in his training would have covered who is the tested party, who should be a tested party. Basically, the crux of the issue is the person who is least complex should be the tested party. So what OECD says, the choice of tested party should be consistent with the functional analysis of the transaction. As a general rule, the tested party is the one which a transfer pricing method can be applied in the most reliable manner and for which the most reliable comparables can be found, and it will not often be the one that has the less complex analysis. So what OECD says is one step further. Though you might have least complex functions, but where you might not find comparable companies or you are not able to make certain reliable adjustments, then to the party which you can do all these things can be the tested party. UNTP manual says in most cases the Indian entity is taken as a tested party and for Indian comparables are used. If the foreign associate enterprise is the less complex entity, it is taken as a tested party. So the tested party is generally the entity which has least complex functions and does not own significant intangibles, whose profitability for the control transaction can be easily verified using reliable data. So before we go into this concept, maybe I will just give you a very small real life example for us to easily grasp this provision. So imagine you run a restaurant and you have your overseas friend come down to visit your restaurant to have a buffet meal, and he eats the food and pays the bill, and you wanted to determine whether the amount that he paid for the food is fair or it is at arm's length. So what is the best way to see whether it is at arm's length? Whether you would want to see the cost that the restaurant has incurred, that the resources that is had, what all intangibles that is in terms of the recipe that is used. You want to test all those things to arrive at that fair price, or you can just test the price that the other person has paid. So basically that's what the OECD also says. So imagine a scenario in this example. So there is one XYZ Germany company. It owns all the intangibles such as IP and patent, and there is XYZ India which gets those IPs, it pays royalty for those IPs, and it manufactures tangible goods in India and sells it in India. So this issue of selection of tested party starts this concept of tested party. It is litigative because of one fundamental flaw that from a practical standpoint we also do when we do the transfer pricing analysis. We always find it easy to test the India side because we have the data for it, and we see the profitability of the India entity. So in this example, in a typical scenario, what would be the international transactions in this case? So if you are a licensed manufacturer in India, you might have import of goods from your group company, or you might pay royalty to your group company. Predominantly these two transactions will always be there in case of a licensed manufacturing arrangement. So how do you want to test this? Generally what we do, we see the margins of the India entity after taking into account these two transactions. So imagine all your sales is to third party in India and you have other suppliers locally also. For example, 100 rupees of sales, you have 70 or 80 rupees of cost. In that only 10 or 20 rupees is from your group entities. To test this 10 or 20 rupees, what we are essentially doing, we are testing the full 100 minus 80. So we ourselves do that and we submit to the tax authorities. Instead, the right approach or the proper approach to do it is with respect to imports. We import it and we do a lot of activities here, and we have the market risk, we have the price risk, everything. So ideally we are the more complex entity. The testing that import transaction that from the group entity side should be the ideal method. But generally why we don't do this practically is majorly because of paucity of data. We will not have data, or generally certain group of companies or certain countries where the companies have MNCs, they don't want to give those data to Indian authorities. They don't want to divulge their pricing and profitability data, or there might be paucity of comparables. You might not find comparables, or you might not have the wherewithal to do a global search instead of an India search. Earlier, this kind of resistance was there also from the tax office side. Tax office did not accept this overseas tested party as a concept because they did not have resources to do the overseas benchmarking and see the profitability. But as the transfer pricing has evolved over these years, even the tax authorities have now the reach to do the global benchmarking, not only for import transaction but also for other royalty transaction. They use royalty stat database and lot of global subscriptions that tax authorities have also got. So slowly, as time evolved, tax authorities have also started to accept this overseas as a tested party concept. So there are two sets of rulings here. One where rejection of foreign AE as tested party by the tax authorities. What is the rationale? Why did the tax authorities reject it? The profit margin of the India enterprise is not that of the foreign AE, which should be compared with the comparables. Basically, they say, I have only local comparables, I can't do overseas comparables, then I can test only the India entities margins. Why should I test the overseas? TP regulations required to consider whether the assessee had earned more or less by doing a similar transaction with unrelated party and not what the AE has earned. It doesn't exactly say that. TP regulations say that who is the least complex entities, they have to be tested. And when the tax authorities have started to accept, there are some certain landmark rulings in case of General Motors and Moser Bear. So now when they start to accept this proposition, so what they say is that tested party is the least complex entity and does not own valuable intangible property or unique assets. If it is not appropriate on the part of revenue authorities to contend that comparable company selected by the assessee doesn't fall within the ambit of TPO's jurisdictions, and thus he can neither call for any additional information nor scrutinize their books of accounts. This excuse cannot be now given. The revenue can get relevant particulars by using the latest technology or database or direct the assessee to furnish that information. That is always there, that power is there with the tax authorities. So, as the provisions or the transfer pricing landscape has evolved, now the acceptability is slightly higher than how opaque the tax authorities were earlier. They didn't accept foreign AE as a tested party at all. So, what are the pertinent questions or the principles that you need to consider when you are going to take a foreign entity as a tested party? So, is the foreign AE the least complex entity in the control transaction? So, there is always a confusion when you do your transfer pricing analysis or in your TP documentation to see whether you have to see the FAR analysis for the company as a whole, or should the FAR analysis be for each and every transaction. This confusion only leads to us taking the FAR analysis for the entity as a whole and doing the overall margin computation. That's where the problem starts. So, who is the least complex entity? First, we need to identify. Is reliable financial and functional data for the foreign AE is available? Ideally, in an ideal scenario, it should be available with your group entities. Does selecting the foreign AE as tested party make the comparable analysis simpler? In a scenario where we only import and the group company is only selling it to us and we only do all the processing and manufacturing, when you test that import transaction, it should be ideally easier. The group company can also have global databases where you can find comparables in those jurisdictions who do this kind of buy and sell activity. Does the foreign AE perform routine functions without unique intangibles or significant value adding activities? And in our import case, yes, they just source it and sell it to us, the raw materials. So when you answer all these questions in affirmative, then you need to ideally select the overseas company as a tested party, and it is upon the revenue to prove why your analysis is wrong, and that they can't prove you as wrong only because there is paucity of data or comparables, because nowadays they have access to all the global databases. So you go by the complexity, which is the least complex entity and whose financials and the pricing data can be easily reliably obtained, and that should be your decision point for choosing your tested party. Royalty, again, you pay a specific percentage, right? You can do a royalty benchmarking. There are various databases available, royalty stat, compustat, where you can find out comparable agreements for an auto client. For example, you can find an automotive related agreements. You just have to pay. It's a paid subscription. For each and every agreement you have to pay, and you will get those agreements, and you do a separate royalty benchmarking analysis. That's what I'm saying. If you do a transaction level analysis, you need not expose your full financials. Your Indian entity need not expose its full P&L for only some 20% of transactions with group entities. The overseas entity as a test. Yes. Yes. So the next issue, I think it's now the talk of the town. I think many of you would have seen the recent ruling in the case of Netflix. So very a landmark ruling in terms of characterization and recharacterization. So what is recharacterization? Recharacterization in transfer pricing arises primarily due to the need to align economic substance of a transaction with its legal form. So substance over form has always been an important tenet as part of your tax litigation is concerned. So tax authorities have always emphasized on the aspect of the substance over form. So when the actual conduct of a parties, what they do is not aligning with what is there as per the contractual arrangement, then tax authorities tend to recharacterize it. So again, I would want to give a small real life example so that you can easily relate to this concept. So my daughter promises me that she would study for an hour every day. So when I go and open the room, she will be there with a book. So for an outsider, in terms of the form, she will be reading, but she has a mobile phone inside and she is playing games. So in substance, she is not studying, she is playing. So basically what you need to see is the actual substance and not the form of it. And that's where when the tax authorities go beyond the form, your legal contractual arrangements, and try to see what you're actually doing, then this recharacterization happens. They go beyond your agreements and they see what you are actually doing, and basis your activities and what is the intent of the parties, they tend to say that this is differing from whatever is there in the agreement. So I will want to do the arms analysis for what you are actually doing and not in the agreement. So this recharacterization has happened in various instances. So there is a loan recharacterization into equity, and there is a recharacterization of overdue receivables as debt. And again in this Netflix ruling, there is a recharacterization of a limited risk distributor to an entrepreneur. This is what the tax authorities have tried to recharacterize. So this is from the Mumbai tribunal. So basically what happens is Netflix, US, Netherlands, both are the group companies, overseas AEs. They provide distribution of access. You see the word access to the Netflix services, the video and content and everything to Netflix India. Netflix India is a user of this license. They agree the terms of use of this with the users upfront, and then they collect a subscription fee from the end user. Okay, so ultimately what Netflix India does is it has its own cost. They collect the subscription fee, and Netflix India is characterized as a limited risk distributor, and they will have a assured return on top of their cost, and whatever is the remaining from after deducting this from the subscription fee, they pay it to the US company as a distribution fee. So Netflix, if you see the second para, Netflix India is a non-exclusive distributor of access to Netflix services within India through a distribution agreement with the, there is a clear-cut distribution agreement with the AEs. All the critical functions like content creation, the overall technology development, the global decision on the strategic discussion, everything is done by the AEs overseas. So the core issue here, we'll go to the next slide. So when this, what the revenue authorities did is that they recharacterize this Netflix India as an entrepreneur. They are not only doing this distribution, low-end distribution of this streaming services, they are doing beyond that, and they can't earn only an assured margin, they should have a bigger share. So what were the key issues? All these 10 issues are very, very pertinent, clearly marked by the ITAT as issues under consideration. First is the characterization, whether low risk distributor of access whether the India entity is an LRD or an entrepreneur, whether the assessee acquires rights, title or license in IP or technology constituting the Netflix service. The next important aspect is there is a concept called open connect appliances. This is nothing but whether an open connect appliance is to be. So what Netflix India does is there is certain technological instrument called open connect appliances. Those are used by Netflix India to store certain videos from Netflix US, and when the bandwidth is very there is a lot of traffic in the bandwidth, the OCS helps to stream these videos through the traffic so that whatever the viewers see, they see it on time. So it is only helping this OCS are helping for seamless video on demand for the users. And what is the benchmarking methodology? Whether the TPO and the DRP are just. So what the tax authority TPO did is they disregarded the TNMM method. Netflix India had adopted TNMM to test the margins earned by them. But what they did is they disregarded this TNMM and they used other method. And then this recharacterization again. So these are the more major important issues that have been discussed in this tribunal order. So what did the revenue essentially do? They characterized them as a technology entrepreneur. They are not a simple service provider, they are a technology entrepreneur. And they considered this open connect appliances, which I mentioned, right? They consider this to be a major technology asset that are owned by India entity. But actually they are not major technology assets, they are only facilitators. Alleged that Netflix India obtains contents and technology in license, bears significant risks and performs DEMPE function. So basically I will pause here to throw some light on what is called as DEMPE. So once the transfer pricing provisions involved and there has been a lot of intangibles and digital economy that has evolved, there is this concept of DEMPE. So with respect to an intangible, there are various stages of an intangible that the OECDs have also recognized under the DEMPE route. So DEMPE means D stands for development, enhancement E, maintenance, and P for protection, and E for exploitation. So what the OECD and the global authorities, including India, essentially say is that break this down into each and every activity under DEMPE and see which entity does what under DEMPE. So the intangible related return for each of the parties needs to be determined based on their intensity of functions in performing these DEMPE functions. So in this case, the tax authority is told that Netflix performs the major DEMPE functions. And then DRP again upheld the order of the lower authorities, and then this went before the tribunal. So tribunal has passed a very, very recent order. It's a very speaking order, and it has done a threadbare analysis of the distribution agreement between Netflix India and US. Each and every clause has been analyzed in a threadbare manner, and they have given their conclusions. So contractual analysis showed Netflix India never acquired IP rights or content ownership. It was only non-exclusive distribution rights. So in certain cases in the ruling, when you read it, they'll clearly say in not all cases you should see only the substance over form. In seeing substance over form, you should not totally neglect the form itself. Form also has to be given some kind of weightage, and there is something that is agreed by the assessee with this group company in terms of a distribution license that has clearly mentioned what are the rights of the assessee. And when the videos are streamed to the local video consumers here, it clearly gives the disclaimer saying that all these I don't own, I am only a distributor. Netflix US or the BV entity held all the critical decision making authority over the content, technology and investment. And clearly the tribunal told this OCA, Open Connect appliances are like logistical device. They are not a technological asset which has of value. They are only helping you to stream these videos in a seamless manner. So they are merely to store temporary content and not anything more than that. The tribunal emphasized that value follows functions and not merely presence. Infrastructure presence and value creation can never always be directly proportionate. physical technological assets alone don't generate residual profits. These are all the very important points noted down by the tribunal. So ultimately what the tribunal did says that what assessee did was right. You have done an over analysis of their functions and you have recharacterized it without any basis. What Netflix India actually does is they are only distributing the rights. They are not entrepreneurs. They are only eligible for a cost plus return for the functions that they perform. So through this ruling, what one needs to take away are these five important facts. This need for DEMPE analysis. This DEMPE analysis is the bedrock where an intangible is involved or a digital economy is involved. This DEMPE analysis forms the basement of whatever arm's length analysis that you do. This is a very, very subjective exercise. There is no right or wrong answer. Everybody will have their own kind of analogy or their explanation for who does the DEMPE. Ultimately, one needs to prepare a robust DEMPE analysis, clearly documenting what are the functions performed by each of the entities in developing an intangible and who is what kind of return one should earn with respect to the intensity of the function that they perform. Technology as ownership. Again, this is being viewed with a big lens by the tax authorities, where in spite of even a small technology like this OCA, if you own, they are saying that you are like a technology owner. It is not so. Ultimately, IP and the technologies with the group entities, I am using these technological assets only to facilitate this smooth operation. So the Netflix ruling, especially when this ALP BIPS 2.2 and the digital economies are now gaining importance, this ruling clearly reinforces the fact that PSM, profit split, should only be applied when the DEMPE functions are equally performed. When both entities are equally involved in doing this DEMPE functions, then there arises a need with respect to profit split. Not all cases where intangibles are involved mandates a profit split method. One needs to very clearly see what is the functions performed by each of the entities, what is the risk assumed, who has the control over the functions and who has the control over the risks. In certain cases, in a practical example, an intangible would be there. The overseas entity will finance the intangible. They will provide the funding for developing that intangible. There ends their role. The intangibles from core is developed by the people in India. Ultimately, the ownership also might vest with the US. But what the OECD clearly says is that just because you are funding and owning an IP doesn't mean that you should get all the returns with respect to the intangibles. Economic ownership should also be considered. So all these nuances have developed because of this digital economy and the evolving business models of various companies, especially software companies. Okay, so the next part is, I think whoever have done a transfer pricing assessment would have got this adjustment on a without prejudice. Every authority, tax authorities will do this adjustment. Even if they don't have your adjustment in a principal transaction, this is one way of doing an adjustment, and they are doing it for majority assessees all through the years. So interest on overdue receivables. So in cross-border transactions, it is a common for Indian entities to sell goods and provide services to group entities. There you might sell to your group entities or you provide services which will give rise to your receivables. They are a debt. There might be a specific credit term agreed with your group entities also for by when you should get the payment. So when the payment gets delayed beyond the agreed time or a stipulated time, so what the tax authorities essentially say is that you have sold your goods and you have agreed for a credit period, but you have got your funds beyond the credit period. So this is not your receipt transaction only for your sales function. You are also doing a financing function additionally to your sales function. This is like a loan that you have given to your AEs for which you should collect interest. So this is the latest issue that is being there for across all the assessees at the assessment level. So what is the central issue here? Does the delay in realization of receivables constitute a separate international transaction and a financing function requiring an arm's length compensation of interest? Or this should be viewed in totality with respect to the sales or the service transaction? How do you have to see it? Is this seen aggregate manner or this needs to be seen separately? So again, a small example. So there is one Rahul who sells cakes and confectionaries to Sahil, who is a US related party with an extended 180-day credit period and no interest is being charged. Due to delayed payment by Sahil, Rahul's suppliers demand immediate settlement, forcing Rahul to take a bank loan at 7% interest, incurring certain additional cost for Rahul. Issue. So extended credit to Sahil led to financing cost for Rahul, raising questions on notional interest and transfer pricing compliance. So basically, whether this interest that the Rahul has incurred because of this delayed payment needs to be recovered from the customers. Yes. Yes, so Rahul has charged an amount keeping in mind a credit period. But if Sahil pays even beyond the credit period, whether Rahul should charge for that extended credit period also. That's what. That's what. It's not charged. Yes, yes. Yes. That's where I will take this in detail. So what are all the questions here in our mind? So is overdue receivables in international transaction the first question? Should there be interest imputed? Even if it is international transaction, should there be an interest imputed? What rate of interest should you apply? And should you do a separate benchmarking analysis for this? What is the ideal scenario for computing this interest, whether it is agreed credit period or actual credit period? In case if you are debt free, you had surplus funds, you are debt free, even then should you charge an interest? This is one other important questions in this case. So there are two school of thoughts based on various rulings. So first school of thought is that they have told, courts and tribunals have told that overdue receivables is a separate international transaction. So there are various rulings, open text technologies, HARSCO, DSM, Albany. So what is the key rationale behind these forums saying that it's a separate international transaction is receivables are expressly covered under the explanation to 92B. In 2012, there has been an amendment to section 92B where there is a separate explanation involved. So a delay beyond reasonable credit period constitutes an independent international transaction. Certain cases what happens is that the assessees will do a working capital adjustment. So they say that I have done working capital adjustment, and after doing that adjustment my profits are still more than the comparable companies, which means that my pricing has taken care of the delayed interest. So why should I charge interest separately? Outstanding invoices from prior year must accrue interest from 1st April of the year as they represent rolled over financing. Typically adopt where there is a LIBOR based when there is a transaction in USD, adopt a LIBOR based interest rate. The other school of thought is they typically say that you don't see these two as separate transaction. TNM allows aggregation. One transaction is just a mere extension of the other. Your sale transaction has just led to this receivables transaction and you don't see this separately. Not every receivable becomes an automatic international transaction. What matters is the pattern of delay. If there is a one-off case and if it is not happening very regularly, then each and every case need not be seen in isolation. TNMM with working capital adjustment sufficiently accounts for time value. When you price your product for sales, taking into account this delay that you are going to incur in collecting this, then by that itself takes care of the interest component also. You need not charge interest separately. Debt-free companies, these rulings say there is no need to charge interest, but basically if you see, even if you are debt-free, you have surplus funds. If you had invested those funds elsewhere, you would have earned interest. There is an opportunity cost involved here. Whether non-AEs enjoy longer credit period than AE, interest adjustment is unwarranted. These rulings say so. You have sales to AEs and non-AEs. To AEs, you didn't charge interest, and to non-AEs also, you didn't charge interest. So, why do you want me to charge only to my AEs when I am not charging it to non-AEs? I am at arm's length. That is a straight comparison. So, what are all the important questions here? With interest on outstanding receivables as separate international transactions. Again, there are divergent views. Some tribunals have held that it is a separate transaction, but certain others have held that it should be aggregated with your principal transaction of sales or service, whatever it is. What changed after Finance 2012? As I mentioned, there an explanation was retrospectively inserted, which said that international transaction to include capital financing, deferred payments, receivables, etc. Can notional income be taxed under TP? Yes. TP is an anti-tax avoidance provision. Hence, notional income is taxable even if entity is debt-free or uses own funds. If no interest is charged on AE delayed payments, can AE transaction escape adjustment? If treatment of AEs and non-AEs is uniform, adjustment may not be warranted based on Indo-American jewelry and Avery Denison rulings. But again, there are other rulings which say that it doesn't matter. I will treat this as a separate international transaction. Should interest be computed on receivables after netting payables? Based on our practical experience, even for this assessment cycle where we are currently doing audits, the TPOs at Chennai accept for this kind of netting. So, what rate is again LIBOR when your transaction that is there in foreign currency? How should delayed realization beyond agreed period be treated? So, there are two concepts called as agreed credit period and actual credit period. So, take an example where your invoice to your group companies when you sell it to your AEs mentions 30 days and you get your payment after 90 days. So, to what extent you have to impute interest, whether it's for the agreed period or it is for the actual period. So, again, when you do the working capital adjustment, you do the working capital adjustment for the average working capital position, which takes into account your actual credit period. So, after doing that working capital adjustment, even if you have sufficient profits, then it means that you have foreseen that there will be a delay and you have factored that in your price when you sold the goods to your AEs. So, ideally, that should have taken care of this. But again, when in a comparable analysis case, you might not get data for actual credit period agreed by the comparables, right? You will not get the invoice data of comparables. You might know the overall credit period through their working capital. So again, here the issue is still not settled. There are divergent rulings in this case. Working capital adjustment is one very logical explanation that you can give, but again, there are divergent views on whether to accept working capital adjustment for not levying this adjustment is again divergent. So important questions maybe as takeaways is, when does this trade credit recharacterize or morph itself into a financing arrangement? After which period it becomes? That is again, that rule is laid down by the tax authorities. In this case, in these last two cycles, they are considering 30 days is the normal market practice. But when you speak with your industry, your clients, they say 30 days is not your market practice. It is easily 60 days. What evidentiary patterns show intent versus incidental delay? So whether this delay is just one-off or incidental or it is intentionally delayed, how will you prove that through evidence? It's very subjective. Should credit terms to non-AEs play a decisive role? So I am not charging anything to non-AEs. So does that abstain myself in charging this to AEs and there should not be an adjustment? It's again a very debatable point. Is the deeming fiction in 92B explanation absolute or context dependent? So this 92B, which gives an overall explanation, has been introduced retrospectively as part of the section itself. But whether you should interpret it on a case-to-case basis or it is blanket applicable for all cases. So again, a discussion point. Till now, any questions? No, so in your example, both these entities are group entities, right? So for a deemed international transaction to be applicable, one entity should be a non-AE. Yeah, that's what. But both of these entities in India, one and two locations that you said, both are coming under the common control, right? They are AEs. So when there are two domestic AEs, DIT will not be applicable. No. There should be one third party entity. Other than. So the next is again one of the most litigated aspects, and it is a favorite subject for the tax authorities. This management charges, intra-group charges. So when they don't find when they find your margins to be very good, you have 40% margins. They can't question your pricing with respect to your sales and purchases because the comparables are only at 5-6%. Then this is their next weapon to say that it's okay you earn 40%, but you are paying management charges. If you had not paid this management charge, you would have earned 50%. You are earning only 40. I don't care whether the 40 is higher or not, but you are earning 40, but you are paying management charges. It should have been 50. So I will treat this as nil. So this is what is happening these days. So what are management charges? So services performed by one or more members of a M&E group for the benefit of the other related members of the group is called management charges. It can be information technology related management support, sales and marketing support, legal services, human resource related support, management and administrative support, financial services, and then procurement and logistics related support or accounting, or your group CFO, CEO might be there in one location. They might provide you with strategic inputs. So for all this you can charge. So if you see the provisions or the regulations, there are no specific guidance with respect to intra-group charges except for in the safe harbor where they have a rate specified for low value adding intra-group services. Apart from this, there are not much guidance with respect to how you deal with intra-group charges. So if you go to OECD transfer pricing guidelines, they provide some key references on understanding how to do an arms analysis for this intra-group charges. UNTP manual and OECD guidelines also provide some kind of guidance. So what are the key issues with respect to this management charges? What the tax authorities say is that most of your clients, when you represent them before the tax authorities, when you ask for supportings to give it to the tax authorities, what you will get? You will get an invoice. They will give you a debit note saying $100 for some XYZ related support. If you ask them further question, they say this is what I have, I don't have anything else. So what the tax authorities require, it is divided into these three buckets. So there is 3 tests that you have to do before determining the arm's length analysis for management charges. Need test. So what is the need for this India entity to get that kind of services from the group entity? There is something that services are really unique and I can't get those kind of specific services from any other third parties, whether in India or overseas. It is my group which provides that, and only they can perform the services to me. Why these services cannot be performed in-house or obtained from a third party? So I don't have the wherewithal within my company to get these services, or anyone in India to get those services. I have to depend on my AEs. That need should be clearly established. Because of this only I am paying this. Without this I can't do business here. This is very, very important to my business. Next is the test of evidence. Again, evidence is not restricted only to your debit note. Debit note is only the initial evidence. Tax authorities ask for each services, whether the people have come here down to India to provide certain technical services, or if they are charging you $100 for some kind of management support, then how have they arrived at that $100? Who were all involved in providing that support? How many hours have they spent in providing that support to you? And what are the email communication evidences that you have for you seeking that support and they providing you? All these are required by the tax authorities during an assessment proceeding. The next is the benefits. So what you have established that I need this, anyhow I need this, I can't do without this, and I have evidences to say that I have actually received this. Okay, you received the services. Has this benefited you? They have provided you services, you have received those services, but at the end of the day, if you are not benefiting from it, then why should you even pay? So how do you prove benefit? Again, it is very subjective. Maybe you can prove them through, if it is a specific technical related support that they have provided, then you can show how your profitability has improved or your throughput time has improved in your manufacturing process because of that services that you have received. You need to clearly prove where was I and where I am now in terms of how this has benefited me. So these 3 tests form the basis of your response to your tax authorities in case of an audit. If you just give, I paid 100 rupees, this is the debit note, please consider this arm's length, they will surely do an adjustment and say this is 0. Generally, they are determined the services to be nil and they charge the full amount as a transfer pricing adjustment. Very, very subjective, but again, that is the very reason that we have to give a lot other the onus is on the taxpayer. Because it is subjective, the onus is more on the taxpayer to prove why it is clearly required. Because if you give proper data, cost benefit documentation, benefit analysis, computational mechanism, everything, then the level of subjectivity reduces, right? If you just give one debit note and say this is required for my business, I am getting the services, it is very subjective. He can say no, I say it is not required. How do you prove me wrong? He will say. So how to prove him wrong? To prove the tax authority is wrong, you have to have all these tests done and documentation provided. That is the exact point I was coming to. The next slide is for your point only. So there is one interesting analogy. So if you see on ruling called TNS India, I think this is the most logical ruling that they have given. So what essentially this ruling says is that not in all cases for management support evidence can be given. So they have taken a very interesting analogy of a surgeon versus an anesthetist. So there are 2 different persons in an hospital when you have to have a surgery. One is a surgeon who performs the actual surgery, and there is a person who takes care of the anesthesia. So if you ask me whose function is important for the patient, is both are equally important. But the surgeon's work you can see visually in the patient's body in terms of he has done the operation, you will have sutures, all those things. But the anesthetist's work, what they have performed, you can't visually see in a patient, right? If the patient has survived the operation, then it means that the anesthetist has performed his job. If without him performing the job, the patient would not have survived. So same way, not in all cases of management support you can essentially show evidence. In certain cases they have done, but it can't be tangibly seen or evidences can be shown, but it is needed for you to survive. In this analogy, they have allowed the management charges. This is one very interesting ruling which was very logical also. So in this management charges, there are what are the legal aspects here is that one important aspect that one the assessees can take before the tax authorities is that what I do, how much I pay is my business decision. You don't question me. It is my business prerogative. That is one where they've in a ruling called Cushman and Wakefield, Delhi High Court, they have taken this. The business wisdom and commercial experience of the assessee cannot be questioned. TP adjustment is required to be made by applying one of the prescribed methods. Generally, what tax authorities do is that if I pay $100 of management charges, they don't do a proper benchmarking analysis to arrive at what is the arm's length, whether it is 50 or 60 or I should have paid only 30. They say you should have paid 0. It is a very easy job for them. But that 0 is not backed by any proper benchmarking analysis. They just say it should be 0. So there are rulings which clearly say that you can't just like the disallow, you should apply some arm's length method and tell me what should be the right amount that I should have paid. If you are saying 0, again prove it, why it should be 0. If revenue authorities disallow management charges, they should not be allowed to so what happens is you have purchase, sales, you apply royalty and other transactions along with management charges. You do a T&M analysis and you arrive at a margins. You have operating revenue, operating cost, and you arrive at a margin. When the tax authority disallows this management charges, then they should not consider this expenses for your operating margin computation also. They should remove it there. So what are all the documentation aspects? Since the services rendered are intangible in nature, it would be difficult to place on record concrete evidence which would irrefutably prove to the hilt rendering of such services. Again, what we discussed, for not all certain intangible services, not for every service you can give concrete evidence. Initial burdens is on the assessee to prove that they have received the services, they have received the benefit, and that is laid down in the special bench ruling of LG Electronics, which clearly says that it is on the assessee to prove that he needs that services, he has benefited that services, and he has actually received those services. Taxpayer can only be asked to maintain such magnitude of evidences as could be expected from a businessman receiving services from an unrelated provider. Certain cases, what the tax authorities do is that they go beyond. They ask for each and every data. When I get that kind of a service from a third party, also I might not maintain so much of data, but the tax authorities might require. So this GE Money Financial Services ruling clearly says that you can ask only so much of information which is required for you to do your arms length analysis, and you can't ask anything under the sun. So maybe Harish will cover the economic adjustment part. It's a short form, like what are the basic economic adjustments conceptually and what is happening at the legal scenario. We'll just cover it for a few minutes and then we can close. That's what. So if you are not able to provide, basically what you are doing is that you are making it a bit more subjective. Saying if the tax authority is getting an additional weapon to say that you are not getting benefited. So what we have to do is that you have to have that kind of a clear write-up on how your business operates, in why your business is unique, that in not all cases you can document the benefit that we have received. Even though if you don't get relief under the lower authorities, generally they don't appreciate the facts as much as tribunals does. Maybe at the higher level they will appreciate the facts even more and you can get a relief.
That will be the case for almost any service, sir. Say suppose you do a sales and marketing, not necessarily you will end up with some customers. So that will be the case for almost all management charges or management support services that you receive. It's all about how you document the effort that is involved in providing these services. Say there is a specific person in group who is helping you with all these sales and marketing activities. You need to capture that so and so person in the group has rendered so and so services. He has went to so and so customers and tried to pitch for these products. However, the customers have not wanted these services, because of which I am not able to enjoy the benefits of the services.
Yeah. That's what. So where the benefits can be quantifiable, that you can show. In certain cases, you have to give this kind of clear explanation.
So moving on, I will just broadly cover some of the key economic adjustments. While it's a broader issue, and predominantly there are plethora of rulings on these economic adjustments. So if you see the various economic adjustments, as Prasanna sir covered in the morning, there are working capital adjustments. These economic adjustments are typically undertaken in case of TNMM, where you aggregate all the transactions and try to test the arm's length margin earned by the company. So typically there can be adjustments in relation to working capital. So basically what is working capital is, suppose say you provide a third party customer, a 30-day credit period that you can repay me within a 30-day credit period. Similarly, your related party, you provide a credit period of 2 months. Instead of 30 days, you provide 2 months. So this additional credit period, what ideally a normal businessman would do is factor this as part of the pricing. Suppose say for a 30-day credit period, you sell goods at 100 rupees. When you provide extra credit, the interest component of the extra credit, you will factor it as part of the pricing and you may sell it at 105 or 110. So this impact, it's not readily available for comparables case. So to make your company comparable to that of say a comparable, and to have it a level playing field, what generally we do is we claim something called as a working capital adjustment. So working capital adjustment, basically what we will do is we will arrive at what is your working capital percentage vis-a-vis what is the working capital percentage of comparables. And you will impute a interest that is prevailing in the market, and you will make that adjustment out of your sales price or basically your profits, to say that my working capital as a percentage of sales is 20%, meaning I'm able to I have a 20% is on a higher end, but 20% of my working capital, basically trade receivables net of payables, is lying as is yet to be received from the group out of the total sales that I make. So my working capital position is higher. Basically, I have to go for funding from third parties or take loans to meet my creditors when I have a high working capital. The second issue is, say, when similar comparables has a working capital to my sales ratio of say 10%. That means they are able to realize their receivables faster when compared to me, and that impact would reflect on the profitability of the comparables. So to compare and make a level playing field, what ideally we should do is we should eliminate these differences of working capital by way of claiming an adjustment. So we will remove whatever is the interest component on account of this difference working capital between myself, that is assessee, and the comparables from the comparable companies to claim the working capital adjustment. This has been predominantly accepted by most of the tribunal, while there is a specific case called Mobis in Mobis, India. It was categorically rejected by the Honorable Chennai Tribunal, saying that not necessarily every time the company has a higher working capital or a negative working capital, and working capital adjustment should be granted. Ideally, a working capital adjustment can be granted only when the assessee is able to substantiate that by doing this adjustment, I can make a better comparison from with the assessee vis-a-vis the comparables. Yes. Yeah, we can. So it all depends on what kind of approach you take in to test these transactions. Yes. So if in TP, suppose you are aggregating all this transaction under TNMM, and what you are testing is margin and not each transactions individually, then obviously you have to claim this working capital adjustment to justify the ALP. Because in this in comparison to your assessee, how you are different from your assessee, you need to eliminate the differences to make sure that it is properly comparable. What is the margin that they have earned vis-a-vis what is the margins that the assessee has earned? To compare that, you need to eliminate these differences. Only then we will be able to make a proper comparison. So that is on working capital. The second is import versus domestic content, basically a custom duty adjustment. So typically what happens is businesses or MNEs, when they come into India, they have various quality criteria basis which they will have a definite ruling saying the group would have categorically said that you should import all these products only from me, or you should get these products only from these vendors because of various quality concerns. While the comparables, on the other hand, which would have largely localized their operations, they would have found a local vendor, they would have found a local raw material supplier, basis which they would not have incurred this component of custom duty. So generally the prices for say a product is determined by market forces. They are generally determined by market forces. So suppose a price of that product is 100 in the market. Your comparable companies or your competitors would be able to sell these product at the set price of 100 and make profit, because they would have largely got a local supplier who would be able to supply these products. However, because of your group's quality concerns and your group's criteria of producing a product in way, you had to import these products from the group. So what would happen is you will incur something called as a basic custom duty. And this BCD, or the basic custom duty that you pay on these imports, is generally non-convertible. Basically, you can't claim it as a credit against any goods that you are selling, or it's a cost to the company. And given that, say, the final prices are generally controlled by market, most of the time these companies which largely import cannot transfer this cost to the say customers. They cannot factor this as part of the pricing, because ideally I should sell in the market, I can sustain in the market only when I sell at a market price. So to this extent, to make a level playing comparison, generally what we can do is we can claim something called as a custom duty adjustment. So we will derive at custom duty divided by total imports. What is my level of custom duty vis-a-vis what is the level of comparables, and whatever is the difference, I can claim it as an adjustment. So I will reduce that level of custom duty from my cost, and same from the comparables as well. So this is the custom duty adjustment.
So the pricing that I set for the ultimate customers is governed by the market forces. It's completely my prerogative. What the Act essentially says in Rule 10B only in terms of economic adjustments is when there is a difference in the comparability, you need to do certain economic adjustments so that there is a level playing field. So your jurisdiction per se is to see whether your level of cost structure and the profits and the comparables are comparable, and if there is any differences, you have to eliminate it. It doesn't mean it is irrelevant whether if I pass it on to the customers or not.
So that is on the custom duty adjustments. We have a ruling in case of Wusu India Private Limited, where the courts have compared what is the level of imports by the assessee vis-a-vis comparable companies. So on an average, it worked out to some 80% in case of assessee vis-a-vis comparable companies, which was much lesser, 14 or 10%, which significantly proves that I have higher imports when compared to comparables, and basis which the High Court, the tribunal has allowed this adjustment. Similarly, yes. Yes. Yes, now there is something called as interplay between transfer pricing and customs. So now tax authorities and the custom authorities, they exchange information, and this SVB is nothing but a valuation which they undertake for all the imports. So basically it's contradicting each other. They are contradicting each other. The tax authorities want you to pay lesser amount for imports because that will result in larger profits and more taxes, while your custom authorities would want you to disclose the higher amount so that they get a higher share in BCD or convertible, whatever custom duty you have to pay. So ideally there has been some discussions that's been going on to have a same level, that whatever valuation that is undertaken by the custom authority be accepted tax authorities also as arm's length.
So in certain cases where we had this import transaction during TP assessment, we had applied other method and given this SVB order as a evidence for that other method, which has been accepted also.
Sorry sir, I didn't.
That's what. In that case, there is no need to apply this adjustment, right? No need to. Worst case only you will have to.
When it is impacting your profitability and you are not able to transfer this cost to the customer, only then you will be apply this adjustment to have a better level playing field. Next is another common issue, which is nothing but a capacity utilization issue. So capacity, to explain in simple terms, say a new manufacturer which is set up in India, they will have something called as a installed capacity, meaning given a year, considering a full complete operations, they would be able to manufacture given set of units. Assume that is 1000. Say, so they will have an installed capacity of to manufacture operating round the clock 3 shifts a day round the clock. They would be able to manufacture 1000 units. The moment you are not able to meet the installed capacity of 1000 units, then you will have something called as a idle capacity. Basically, you are not able to satisfy your complete installed capacity. So what happens in business scenario is that all these fixed overheads that you incur in India, fixed costs, rent, factory rent, everything is all fixed amount. You would be able to, or you would have planned your business in such a way that only when you fully utilize the capacity of 1000 units, you would be able to recover all these overheads. You would be able to recover the fixed cost, whatever you have incurred in it. So the moment you are not able to satisfy that installed capacity and you have some idle capacity, that will result in an idle cost. Basically, you will have certain cost which you are not able to recover through sales. That will result in your loss. So generally, most of the companies in their initial years of manufacturing operations have this issue of low profitability. So what happens is that before the amendment in MCA regulations 2012, every company has to disclose this capacity installed and replaced capacity in their financials. So basis that, companies were claiming these economic adjustment, that is, my comparables or my competitors were able to fully utilize their capacity. They have a higher capacity and they are able to utilize that capacity, resulting in recovering their fixed cost. While on the other hand, I am not able to fully utilize because I am a new entrant in the market and not able to fully utilize the capacity, which has resulted in me making losses. So to compare me with the comparables, I should have the same level of capacity. For that, the assessee claims something called as a economic adjustment in relation to idle capacity. So how that is computed is, my level of capacity is, say I manufactured only 500 units out of 1000. That gives me a 50% utilization. While on the other hand, say comparables were able to manufacture 900 or 700 units. That will give them a higher capacity utilization of say 70 to 80%. So this difference between my 50% and the comparables 80% higher utilization is this 30%. I will reduce my cost, that is reduce my fixed cost. Ideally, if I had manufactured at that level, I would have able to recover this 30% of fixed cost. So I will reduce this cost to compare my profitability with that of comparables. So this is the capacity utilization. But what happened was the government notified it and issued an amendment in MCA that companies are no longer required to report this capacity data in their financials. So this became a big issue in claiming economic adjustment, because you will not have the data of comparables on their capacity, how much capacity they were utilized during the year. So because of this, we have tried in our experience, or we have tried out various other scenarios. So one, for example, is the RBI data. So RBI generally issues publications year on year on the capacity data for the manufacturing sector as a whole. So so basically month on month there is a RBI publication which gives out, they undertake a survey of all the manufacturing companies, majority of manufacturing companies, and they get the data of how much capacity they have utilized during a given year. So you can take that as a basis to claim this economic adjustment. But courts have said that this analysis or this publication that RBI has issued is generally for the whole manufacturing sector as a whole, and that does not reflect the actual product. Say suppose I am in auto sector, the assessee is in auto sector, while if you compare the capacity utilization of the entire manufacturing sector as a whole, that will not make sense. Basically, you are comparing yourself with the entire manufacturing, not necessarily that auto sector as a whole. it is important to compare how auto sector has flared vis-a-vis what I have done in the market, instead of comparing the entire manufacturing. So the courts have always disputed on this. We have a Chennai tribunal case on this, Bonfiglioli Transmissions Private Limited, which specifically allows taking taking RBI data as a base to compute the economic adjustments. And there are other disputes as well, whether you will do this adjustment on comparables or whether you will do this adjustments on assessees.
So there are other tribunal rulings which have gone one step ahead in this issue, saying that just because information of comparables is not available, that is not a basis for you to reject this adjustment. Anyway, you have powers under 133(6) to get those information from those assessees, right? You exercise that power and get the data and compute the capacity utilization. Don't reject it just because the information is not available in financials.
So yes, that is capacity. Recently, so generally the other issue that's been going on is that these capacity adjustments was generally awarded only during startup phase, basically the initial year of manufacturing operations. But recently there is another Chennai ETAT ruling in case of Caterpillar India Private Limited, wherein the court have specifically said that these adjustments need not be restricted only to the startup phase. So there can be various reasons because of which the assessee is not able to fully utilize the capacity. Say one can be lack of demand for the product. On a overseas level itself, there is a lack of demand. Or suppose say you are not able to say the level of, there are some other reasons, you have a shutdown in the business suddenly because of some regulatory issues. COVID is one such example. So these situations, external factors which the assessee does not have a control over, can also be a reason for claiming this idle capacity adjustment. So that was discussed in Caterpillar India Private Limited case. So moving on, the next is in difference in business model. So basically the operating model in which say the assessee vis-a-vis comparables will also, so ideally if you ask me, the main reason for all of this economic adjustment is that not applying an appropriate method. Say based on what level of transactions you do or what level of functions you do, it is important that you select the most appropriate method for doing the transfer pricing analysis. These economic adjustments you would generally be undertaking in a situation only when you are not applying the appropriate method. Say in case of companies, say for example, you are not able to fully utilize the capacity and you have incurred losses. In that situation, the ideal scenario is to see, like SRINATH said, you should select the most appropriate tested party in that case. So you can test the overseas entity and what are the level of profits that they have earned from selling the inputs. That can be the best approach in that situation. So any of these economic adjustments will not be required if the assessee has selected the most appropriate method as the relevant tool for its transfer pricing analysis.
So when Prasanna would have told you about all the transfer pricing methods, basically there is also a hierarchy, maybe kind of how we can choose. So there are price-based methods and profit-based methods. So preference should always be given to price-based methods because there is a direct comparable. Only when you're exhausting all those because of availability of data, you take TNMM as a residual method. But ideally, what we do is the reverse. We only take TNMM because that is the most easiest method to do. That is the reason for all the litigation that is happening.
Yes, so that's it from us. And in summary, if you see the TP litigation, transfer pricing landscape as such, it has become so significant that tax authorities have started digging deeper in terms of what all the key functions that you do, how you conduct the business. So it is important for any MNEs or corporates to structure or to strategize their TP policy right from the moment they enter into the transactions. So ideally, there has been a trend, or the corporates have generally, what they have done is only when at the time of assessment they wake up, they try to do a post-mortem of their transaction, trying to fix the issues that was already existing. So the better approach is to, right at the time when a company enter into a transaction, they plan it properly as to set a proper transfer pricing analysis and various set of documentation that proves that you perform so and so functions while the AEs or the associate enterprise perform so and so functions. Basis these functions, I am remunerated or the assessee is remunerated for whatever functions they do, and they are not remunerated higher or the lower. So what is important is we are all discussing about the TP implication from this side, that is India side, whether India is being compensated ALP or not. The other aspect is important also, whether what happens from the USA. The moment you get more than ALP in India, that becomes a problem in the foreign country as well. Suppose the ALP is determined as 100, however you get 105, it will not be an issue in India, but this becomes a problem in US for their type P purpose, because they are paying more to India than what is required. So this, there needs to be a holistic view when a particular transaction is entered into, and it is important that companies or corporates strategize this very well before it is getting selected for the scrutiny. Yes, sir. So yes. So again, like you said, it all boils down to the point on what kind of comparables you take. So say for example, let's take an example of IT company, which is a new entrant in India. You can't compare the activity that the new entrant has done vis-a-vis a Wipro or a Infosys. So it's all boils down to the kind of comparables that you select, and that's why it's required a detailed analysis. There are various filters. There's something called as upper.
So that is where you do something called as a risk adjustment also.
So courts have held that, say you do not assume market risk. So you are, since you are a captive, you do not assume market risk. You do not have any credit risk or a contract risk, because all this you are attributing only to the related parties. So in that situation, courts have held that something called as a risk adjustment, where they give a ad hoc 1% or a 2% reduction in the margin compared to comparables. While this has not been preferred as much, the best way to go about is doing an APA or a safe harbor, which will give you a certainty in terms of litigation aspects. Otherwise, this issue is always there, sir. So, like you said, because we apply something called as a related party filter. Basically, companies which have related party transactions more than 25%, we will exclude those companies. We cannot compare because their prices is also influenced. At any point in time, you won't get any comparable which is going to be of a similar functions that you are going to do. So the best way is to, of this, how do you justify your functions vis-a-vis comparables?
Again, to your question, all the other companies are doing full blown. I'm doing only a captive. But again, with respect to software development function, what is the margin that you have to earn? Law by itself says that what an uncontrolled person would charge for these services. It then again goes to comparables. So an uncontrolled transaction means uncontrolled entity doing such kind of services will charge 20%, means you have to do 20%. The end of the day. Because that is the basics thing of TP.
So this is where generally
Basically, safe harbor just comes with a small premium, 17-18%. Ideally, if you do 14-15%, in case of an assessment, you can try to come out. But if you don't want that pain, you don't want to get into litigation, you pay 2% premium, and you agree at 17%. We will not pick you for assessment. That is the concept of safe harbor. It all depends on the risk appetite of a company. If a company feels that I will fight it out, I know it's only 15%, mine is low, and I will fight it out and get it, then you do not go for APA or safe harbor. But if companies don't want this headache, I have other commercial and business headache, tax headache I don't want, then you upfront agree.
so it specifically says 1 month before the due date for filing of income tax return. One month prior to the 139(1).
Thank you, Srinath and CA Harish, for your wonderful session. There is one announcement from SARC. Okay, there is this AI conference to be held on 19th and 20th. So members are requested to participate. The fees is 3,500 plus GST. Okay, with this we are winding up this session. Thanks again for all the speakers, Srinath, Prasanna, and Harish. Thank you.